women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on Bloomberg Television. Here's the price action. 6-day losing streak coming into Wednesday on the NASDAQ. Just a little bit of a bounce back here. The NASDAQ 100 up 0.1%. S&P 500 futures up 6. Also up about 0.1%. The Russell doing nicely. It's been a brutal week, though. Switch up the board and get to the bond market. 2s, 10s, 30s. We look like this morning. Yields up, curve steeper. Up about 5 basis points now on 30s to 223. On 10s to 137.
Great sound effects.
Your 2s, 10s spread gets to about 125 basis points. You know what? I'm going to take some days off soon. Some vacation. We'll get Tom out here in front of the big wall.
I'm
looking forward to that. I'm really looking forward to that.
We all are.
Curve steeper, yields high. You know the story. Who does it benefit? If it's a statement of confidence, as Chairman Powell talks about, then it's good for global growth. It's good for US growth specifically. You add in that, what you get? Higher bank stocks. Get to this. Switch up the board. We're talking about big tech all the week. The banks have done so nicely year to date. And over the last 5 days, this is what we look like on a KBW Banks Index, up by about 3.85%. So higher rates, a better outlook. Banks look better. What else looks better? The way we engage with this economy is going to change. So what's performing really well over the last week or so? Travel and leisure over in Europe, Tom, up about 5.5%. That's been the story. What benefits from a better outlook? Higher interest rates, accelerating growth. What benefits from a change in how we engage with the economy? Those two sectors.
I see a return, John, to Capri. That's what I would just suggest here. I think, May says Capri for John Farrell. Right now, this is really important. We're going to dovetail all the emotions and movements of the market into a one salient point, always captured by Stephen Stanley in his important notes for Amherst Pierpont. He's award-winning and all that in economics, but far more, he cuts to the chase. Stephen Stanley, you go back to William Phillips of the London School of Economics with his crazy contraption, looking at where we are on inflation and where we are on wages. Do we have to fear wage inflation when we say where in the world is the Phillips curve?
Well, it's really interesting how the Fed is approaching this, because last summer I thought we had killed the Phillips curve and buried it. But as it turns out, the Fed thinks the Phillips curve still exists, but only in one direction. So they're going to ignore tight labor markets, and they've kind of severed the link between tight labor markets and higher inflation. But they're telling us that inflation is not going to pick up in the near term because the labor market is soft. So apparently they still do believe the Phillips curve works, just only in that one direction.
You were wonderful in this, in that we're going to get a lower unemployment rate. We're optimistic. We all believe that. But do you see evidence that ECI, wages and benefits, could get back to somewhat normal? I don't see the evidence out there.
I think it's really hard to say. I mean, clearly we've seen increases in wages, but basically people are getting what amounts to combat pay. They're getting paid extra to work because they're taking on more risk. Once the pandemic ends, the labor market is going to hopefully get back to something closer to what was normal before. And I think it remains to be seen what that means for wages, whether wages are going to continue to rise as they have in the pandemic or go back to something closer to where we were before all this started.
Meanwhile, Stephen, a statement of confidence. That's what Jay Powell said yesterday about yields rising. And we are seeing yields continue to rise today, although it isn't necessarily on higher long-term inflation expectations, but really just rising from an absolute level, real yields rising. What do you make of that?
I think people are getting more optimistic about the economy. I think that coming into the year, people were starting to get more optimistic, but it was still kind of speculative. Like, okay, maybe things are going to be better in 3 or 6 months. And now I think you can see it. You know, you can see a path to a much more reopened and normal economy just within a few months. And so I think the reality is starting to set in that, hey, we might actually get something, you know, some really strong growth and get back to something close to normal in a period of time that I can actually foresee.
Is there confirmation based on the price action, Stephen, that risk assets can continue to rally even as we have a normalization of rates the way we are seeing right now?
Well, I think it's going to be interesting. I mean, I think in some ways it's a lot more complex today than it was, say, a month or 2 months ago, because coming into the year, it felt like it was very binary. You know, you'd come in and the markets were either risk on or risk off. You know, are we going to get more stimulus or less? You know, was there vaccine news or whatever? And now what you're saying is that people are actually starting to think through the more nuanced implications of, okay, if we open up, what happens? Well, interest rates go higher. Is that a problem for the economy? We might get less stimulus, either fiscal or monetary, at some point. You know, so there are a lot of questions that are starting, I think, to be breached. And so you see, you know, more complicated reactions in the markets. You don't just get that binary risk on or risk off. You might see everything selling off at the same time or everything rallying at the same time.
I sense a pervasive lack of belief in the Fed's reaction function, Stephen. Maybe I'm wrong. And Tom, you and I have been talking about this now for about 12 months since we had that big shift last summer. And I just look at the way things are going and they're telling you the same thing repeatedly. We're not going to come in and spoil the party anytime soon. And as things get better, Tom, they're going to keep repeating that message. And it just seems to me that people still haven't capitulated yet on that.
I mean, John, please go to Mr. Stanley on this, but I would just observe, John, that the great mystery before pandemic, in pandemic, and after pandemic is the technological implications of this society. And one of those implications is the lack of wage growth.
So, Stephen, let's talk about this. Why the lack of belief in the Fed's reaction function still? And do you think people will be surprised as the year grows older and the economy improves by the very fact that they will stick to what they said they would do?
Well, I think the Fed is very committed to basically erring on the side of ease. They want to stay at zero longer than than maybe the economic conditions would dictate. Maybe they're going to continue to buy assets for longer than the conditions would dictate. I think the Fed is maybe in for a big surprise in 2021 based on, at least on their latest economic projections. It seems to me that the Fed is working from the game plan of the last cycle. So they think this is 2011 and that the economy is going to just kind of rebound modestly and we're going to have a lot of time. So they've talked about being very patient about when they're going to taper. And then when they start to taper, it's going to be very slow. And then there'll be a period after they stop buying assets before they would raise rates. And then when they raise rates, it's going to be very slow. So you don't get back to normal monetary policy for years and years, which is consistent with what their dots are showing that they're projecting at this point. I don't think this is 2011. I mean, there's obviously not an exact analogy, but the closest one I can come up with is the end of World War II. You know, you're reopening the economy all at once. You're bringing a lot of people back into the job market all at once. And that was also a period where the Fed stayed very easy, in part because they were helping support a huge, fiscal problem. And we got a lot of growth and a lot of inflation over that period. Now, clearly that's a long time ago, and there are a lot of differences in the economy today. But I just think the Fed may be underestimating the degree to which and the speed at which we're going to get back to normal.
Steve, this is really important then. Are you suggesting that this $1.x trillion stimulus is our modern Marshall Plan?
It's funny. I think it's more like, in my mind, it's more like the guy jumping in front of the band, right before they get to the stand, and then acting like he's the leader of the band. I mean,
Pharaoh does that constantly. I mean, Jesus.
Yeah, there are a few things in that package that we do need. We do need to do unemployment benefits beyond March, and any money that we spend on vaccines and testing and treatment obviously is money well spent. But I think a lot of the more, the idea of having to stimulate the economy right now, I mean, by the time those huge rebate checks go out, we're going to be starting to reopen things. So you're adding a lot more, deficits and debt to an issue. And I think, maybe it works out okay because it just kind of provides additional tailwind. But I think it's just going to add fuel to the fire. You look at the level of savings, both in households and businesses, and you reopen the economy, you're going to get just a massive flush of spending that comes through, and add another $400 billion, and that's just going to add more on top of it.
Well, Stephen, let me jump in. Lisa, let's just look at where the Fed is for the rest of this year and into 22. And let's talk about where the street is right now. And let's use the estimates of Morgan Stanley. Lisa, 4.2% is the forecast for real GDP this year from the Fed. Next year, it's 3.2. Here's where Morgan Stanley are at.
Okay, traders, as you can see, I adjusted some information on chart for British pound. Yesterday, we sold short at 140.77 in going steadily to this point. We also have another position at 141.77. So I'm going to move my stop on profit to 141.57. It will give us 20 pips, and depends on what broker pays you per pip. You will see already profit, what you will get profit from first trade we did today. So let's wait a little bit. Let's see how far this chart will go, and maybe we will sell both positions within a profit. Okay, I'll speak to you later, guys. So you need to put stop on profit to 141.57.
At every stage, I'm not sure that's appropriate for a situation where things are moving very fast, much faster than you would see in a normal business cycle.
Stephen, we've got to leave it there. Always great to have you on the program, sir, for your contribution. Stephen Stanley there of Amherst Pierpont. So here's what you want to think about as an investor right now. What's the biggest risk? The upside risk that we get this big upgrade to forecast at the next meeting of the Federal Reserve and the dots stay where they are? Or the downside risk that we get that upgrade to forecast, Tom, and the dots start to gravitate higher?
That's the ambiguity, but I'm going to go to the micro-analysis right now, John, which I think is really important, looking at hospitalizations, looking at death, looking at the better numbers. I was at a match yesterday, John, on 65th, and they are micro-analyzing their ability to put tables inside in their restaurant, and the great owner said to me, we're adding 2 tables this weekend. The city is allowing them to go to 35% occupancy. John, those are the micro decisions that end up folding into our world.
Did you get a free drink to give them a shout out?
Seriously?
The following morning?
No, I did not get a free drink. I got free drinks. The Pernod was absolutely perfect, if you must ask.
With his combat pay, he used his to go to match.
Combat pay to get the Pernod.
There's got to be a story there somewhere. I just wonder how long lunch actually lasted. For everyone that thought I was joking yesterday, Tom did not watch that testimony from Chairman Powell.
You got that right, John. But what we three are living in each of where we live, every restaurant day is important.
Totally agree, Tom. Totally agree. From New York City this morning, good morning to you all. Alongside Tom Keene, Lisa Abramovitz, I'm Jonathan Ferro. S&P 500 futures.
Keep going, John.
Unchanged. I've been living with this for years. This is Bloomberg.
In New York with the First Word News, I'm Karina Mitchell. The House will vote Friday on President Biden's $1.9 trillion stimulus plan. That's according to Majority Leader Steny Hoyer. The president expects the package to pass by a narrow margin. The big question is the fate of the $15 an hour minimum wage. 2 Democratic senators currently oppose it. Meanwhile, Joe Biden and Canada's Justin Trudeau set aside differences over trade and other issues in their first meeting. The two conducted a virtual summit lasting 2 hours. They said their nations would adopt a unified approach toward the pandemic, climate change, and China. More fallout from that engine failure on a United Airlines Boeing 777. The FAA has ordered high-tech inspections of Pratt & Whitney engines that are used on 777s. A fan blade in the United Jet's engine snapped, tore off another blade, and then the front structure of the engine. And the British government has unveiled a $988 million plan to help young people catch up on lost learning due to the pandemic. Money will be used to expand tutoring programs and to help schools provide more activities over the summer. Schools in England are set to reopen March 8th. Meanwhile, Bitcoin briefly hit 51,000 again today. The rebound follows a tough week for the world's largest cryptocurrency, sinking to 45,000 yesterday, reviving doubts about the durability of a five-fold rally over the last year. It did find support from ETF superstar Cathie Wood, who said she's very positive on it. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. Stay with us. More to come. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
We will still see cases, we will still see outbreaks, we will still see deaths, but they will be nowhere near the levels that we saw during the height of this pandemic or even now. But it's not going away. It's established itself in the human population. It's endemic.
Mesha Dowja there, Johns Hopkins University senior scholar on the reality of the outlook for COVID-19. From New York City this morning, good morning to you all. Alongside Tom Keane, Lisa Bravitz, I'm Jonathan Ferro, getting you set up for the market day this Wednesday morning. Here's the price action. Equity futures, you've got to stay unchanged now. Up about 2 on the S&P 500. Not much happening there in the equity market. 6-day losing streak on the NASDAQ. A mild move higher this morning on the NASDAQ 100. Turns into a little bit of a move lower on NASDAQ 100 futures, off by about 18 points. Elsewhere, outside of that, take a look at the bond market. Yields are higher on 10s by 2 basis points. And we keep going back to this, Tom, on 30s by 4 to 2.224%.
Yeah, I think that's a fixed income headline today. The idea that the yield farther out the yield curve, folks, really advancing to a new steepening. And I'm watching again that correlation over the dollar through DXY, the blended big currency index, 90.1. But we did see an 89 handle earlier. We'll do this all through our simulcast today. Lauren Sauer at Johns Hopkins University joins us now, the Associate Professor of Emergency Medicine. Lauren, I was really taken by your colleague Ashish Jha at Brown University yesterday, really talking about the ability to extrapolate out this good news. Can we extrapolate out responsibly the declining death rate?
Yeah, absolutely. I mean, I think everyone is thrilled to see these numbers take a turn. I think there was concerns that we would stay high. I do know in his comments, he did say part of the good news, I think, is because we were so high to begin with, right? So it is a great trend, and we want it to continue, but we don't want people to get too complacent in looking towards that going back to normal, because the numbers were just so high to begin with and things were so bad here. So, you know, it's like keep up the good work sort of message where we continue to do the hard work and move forward those numbers.
You're an expert on the path from the emergency room to the rest of the hospital. What's it look like right now?
Yeah, the emergency department is sort of the gateway to the hospital, and so we have to keep those patients moving through, and it is looking a lot better. We're seeing people being discharged from the emergency department to home or to sort of mid-level care spaces, which is better because those high-level, high-acuity hospital beds like the ICU can take those sickest patients. So the hospital is, I would say, are definitely looking better, and the key will be to maintain that into the summer.
In the meantime, Lauren, people are taking a look at the vaccine effectiveness, and yesterday, actually, Treasuries took out a rise after there was a report that the vaccine that were available was not necessarily that effective with the South African strain of COVID. What are we learning in terms of the effectiveness in combating some of the new variations of the coronavirus?
Yeah, I think we're continuing to see, as those variants increase in numbers, the potential efficacy of these vaccines. We know that may have had an effect on the Johnson & Johnson vaccine, that single-dose vaccine that's on its way out now. But the good news of many of these vaccines is that they can be adapted, and we can create booster shots that build protectiveness even when a variant looks not well protected against. So we have the technology to improve those vaccines, I don't want to say on the fly, but in a much more rapid time. And we did just hear from the regulatory agencies that we won't require large-scale clinical trials to adapt those vaccines, which is great news because that means we can get boosters, we can get changed vaccines into arms quicker.
We've heard, Lauren, from a number of different health professionals, some saying that we could see in April herd immunity of some sort with many, many more individuals being vaccinated in the United States. Others say people won't be able to get vaccinated en masse until June, July. What's your impression?
I think herd immunity in a little over a month is unrealistic, and probably not the message that people need to hear right now. We have to set expectations very honestly. We have to be transparent about the path that we're on and make sure that people don't change their behavior abruptly to make those numbers take a turn for the worse. So it is great to see the numbers trending down. I think we're on the way to herd immunity, certainly, but herd immunity is a challenging sort of concept to assess, and so we have to continue to watch the vaccination. Right now, everyone who wants vaccination is lining up to get it, and it's taking a while, but they're all lining up. Now, once we get to a point where vaccine is prevalent across the country and across the globe, we don't know if people will continue to line up for it. We have to wait and see if people continue to sort of show up to get that vaccine as the supply increases. So I think it's not realistic to expect that we would have herd immunity in the next few months here. But it is realistic to say that we're on the right trend, and we have to keep working to get vaccine into people quickly.
Professor, I'd love for you to comment on the vaccine rate, the vaccination rate that's fallen back to a little more than 1.2 million average over the previous 7 days. Was that just the cold snap? Is that something else?
I think the weather is playing a big part in it. I think the weather makes it harder to get vaccine to sites. It makes it harder to get people to the sites, and it makes it harder to encourage people to show up safely for those appointments. So I think we'll wait and see for these next couple weeks here as the weather hopefully continues to improve, with the hope that we didn't lose too many vaccines in some of these big storms, and also that people who missed appointments can easily and effectively reschedule them so that we don't lose people to either second doses or people who are sort of on the fence about getting vaccine, making sure that they are able to reschedule their appointments.
Lauren, your time, it truly is precious, and we appreciate that you've given some of it to us this morning. Thank you. Lauren Sauer there of Johns Hopkins. The vaccine rate dropping back to a little more than 1.2 million in the past week. I think most people would assume largely because of the cold snap. The numbers right now, Tom, look like this. In the United States, 20 doses given per 100 people. 13.4% of the population has had at least one shot. 6%, including you, sir, fully vaccinated.
Well, grinding it out every day. I would really focus on the everyday of it. That's the way all of this is, back to World War II, back to the advent of modern vaccination. And with the booster shots, John, you just have to grind it out every day. And again, I'm going to go back to the Axios cover of 2-3 days ago where they just simply said America leads.
Well, I'm going to go back to the travel and leisure stock story that I brought up about 30 minutes ago, Tom. Largely off the back of what's happened on the vaccination front, not just in the United States, but in Europe too, particularly in the UK, specifically in the UK, where 26.8% of the population, Lisa, has had at least one shot. And the government, led by Prime Minister Boris Johnson, has come out with a plan, basically said step by step, hopefully, this is what reopening looks like.
And the idea that we're getting data showing that you might not be contagious, that you're actually all clear if you get vaccinated, which was the point. And we were talking about this yesterday, but I think that the increased guidance from the United States, the CDC, saying something similar, also giving people confidence to get on a plane, like you talking about vacation.
Or Tom coming back into the same room as us. Wouldn't that be great?
Yeah, when's that gonna happen?
I think you're coming into the same room with me.
To you. We're coming to you.
Yeah,
Is that how that's going to work?
I got the surveillance tape measure here, and maybe I can go out there and you two come in here. It's a great plan.
Are you going to do the boards?
He's good. I don't know. We're going to bring the podium in here.
I think we can arrange that.
Yeah, we're going to bring the podium.
We can arrange that. I don't know if we should be maintaining this distance or closing it with or without a pandemic.
Can I do a shout out watching this morning or this evening, I should say, on the other side of the world?
A restaurant? Who is it?
Queensland, north of Brisbane, Mermaid Beach. Mermaid Beach, watching. Good morning and good evening to you. Thrilled you're catching up on the New York markets from Australia.
Very cool. I spent some time in Brisbane a long, long time ago.
There must be stories.
Please, would you like to tell us
There are
about
many,
it?
of course. Coming up,
the bar closed.
Julian Emmanuel of BTIG. Isn't it called The Valley in Brisbane, where people go out? I think it is. From New York City.
It was a Veronica's concert, I know.
This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We can see a situation where the U.S. economy grows faster than the Chinese economy in 2021.
As you see the economy further reopening, as you see a shift back towards services spending and a normalization in activity, a lot of those jobs can come back quickly.
We're creating really tight markets, whether you're talking metals, energy, agriculture.
We're reaching this critical shortage of durable goods in the U.S. and elsewhere.
What is the outlier event we could see in 2021? It's a blowout year for the economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. In markets, there is always something to worry about. There is always a shark close to the boat, a tidal wave on the horizon. And Tom Keene, 12 months ago, what were we worrying about? The pandemic, shut down, the economy never recovering. 12 months later, what are we worried about? The economy overheating. That is just the nature of financial markets, Tom. We'll always find something.
I looked at first principles, John, and I think it's been parsed by a number of equity strategists, including our wonderful guest coming up. And, John, that's the idea of, do we have a true rotation or do we have a catch-up from the gloom that we've all felt for the last year? To me, it's one big normal, healthy catch-up, and I have real trouble being gloomy when you give me a 6% statistic.
The embodiment of the gloom, Tom, the embodiment of it, of the pendulum swinging from the world is going to end to things are going to overheat.
John,
allow me to present to you.
Look, no,
Lisa Abramowitz.
There is a fair question, though, about, okay, are we moving to a new paradigm of faster inflation? This is what people are thinking about. And what does that mean for a Federal Reserve that does not see that reality on the horizon? What does that mean in terms of their reaction?
I totally disagree.
That is a question in markets as they look at potential overheating. As you look at that dissonance.
I can't go on the weekend. It's too expensive.
Well, we could have therapy in the break, John.
We can do bear crew therapy or something like that. I can think of a panel.
I don't, John, I just don't agree. I respectfully disagree with inflation worry right now when I see the output gap where it is. I know I sound like Lawrence Summers, but I'm sorry. You've got the output gap with it is. When's it going to close?
Well, the point that the chairman's trying to make at the Federal Reserve is 10 million fewer people employed now versus 12 months ago. And I think the point some people are trying to make is that that gap can close really quickly and maybe so quickly that the Fed is taken by surprise. I think they need to upgrade their forecast. We all agree on that. What will happen with policy subsequently, that's the debate.
Go to Lisa. Dr. Phil just called. I got to talk to him. Look, I'm sorry.
Okay, go carry on with Dr. Phil. There is also a question about asset prices continuing to run ahead of the growth that we actually see. At what point does that create a financial stability risk, especially when you don't see the underlying economic growth and when you do have a lot of people that might not be able to afford the commodities and the goods that are getting a lot more expensive, which raises the question of what kind of inflation we're going to have. There's plenty to worry about, believe me.
I agree on that point. Mohammed Al-Erin wrote about this in the Financial Times earlier this week, that if we do have some financial stability risk, that can undermine the recovery. And Lisa, you could have this dynamic where the economy gets better and the markets don't perform. You could have that dynamic.
Yeah, the real economy gets better.
That's perfectly conceivable.
Absolutely.
After what we saw 12 months ago, very much so. Looking at the market right now as we count you down to the opening bell, and another day of testimony on Capitol Hill for Chairman Powell of the Federal Reserve. Here's your equity market, up about 0.1% on the S&P, a 6-day losing streak on the NASDAQ 100 futures unchanged at the moment. We'll talk about that a little bit more a little bit later. In the FX market, euro dollar 121.66, up a little more than 0.1%. And in the bond market, Lisa, 2s, 10s, 125. That is your spread. Yields are up. The curve is steeper.
Yeah, and we didn't even talk about the fact that the U.S. sold 2-year treasuries yesterday at a premium for the first time above 100 cents in the dollar. We'll be talking about that later. I'm sure we'll weave it in somehow. Meanwhile, today, day 2, we've been talking about Jay Powell returning to Capitol Hill to talk about this sort of interesting navigation between things looking better but holding policy where it is, taking an easy stance to allow the economy to get going, saying things are not even threatening to overheat at this point. We're also going to be hearing from Rich Clarida, Vice Chair of the Federal Reserve, at 1 p.m. and 4 p.m. 10 a.m. we'll also be getting home sales, new home sales in the United States. This has been one of the hottest areas of the economy. I do wonder how much momentum we can continue to maintain given how high some of these home prices have gotten and as interest rates continue to rise. And then 1:45 p.m., President Biden is signing an executive order on supply chains, looking into some of the shortages in chips, in semiconductors, and other essential items for the United States, particularly with an eye toward China. And I know, John, you've been talking about how this indicates how President Biden's administration in some ways is mimicking the path of President Trump's administration. The question is what the follow-through will be from Congress.
Yeah, policy, a big conversation on this program for the weeks, months, and years to come, of course. 1 p.m. Eastern time. Lisa mentioned it, and Tom, I totally agree with you. Vice Chair Clarida, the one to watch a little bit later, discussing the U.S. economic outlook and monetary policy at a virtual event hosted by the U.S. Chamber of Commerce.
10 seconds why, folks, you should listen to Richard Clarida. His academics is profound in the middle 1990s with Gertler, Clarida, Gertler. These are definitive papers, John, thinking about the dynamics of our macroeconomics.
And in the minds of many, he has been the cleanup act after Chairman Powell has spoken, Tom.
Yes, well said. I hate to say that. That would be particularly early on.
Joining us now, Julian Emanuel, BTIG Chief Equity and Derivatives Strategist. Julian, let's go from the top. Always something to worry about. Are you worried about things overheating?
No, not at this point. That to us is a later in the year idea. Although clearly the narrative did change somewhat yesterday. I was kidding with Lisa before the break, is that Jay Powell is not as much in the gloom crew camp as he was, talking about 6%. But ultimately, you have to take the Fed at their word that overheating, the definition is core PCE over 2% for a multi-month period. We're nowhere near that point.
Do you think a multi-month period gets it done, Julian?
Well, that's an open question, which again is why when we're thinking about this yield backdrop, we think yields move higher. Obviously, the last couple weeks has certainly been a bit jarring because of the speed. We don't think the speed of the last several weeks translates into the rest of the year. And so ultimately, put that all together, it's going to be a path where this employment situation is probably going to take longer than multi-months of above 2% in the PCE.
Julian, Rule 101, going back to Maggie, 1948, is you need catharsis to move the needle. Maybe we got catharsis at 58,000 and Bitcoin. History will tell. Do you see any catharsis, any topping out, head and shoulders, blah, blah, blah? Do you see any catharsis in equity action?
Not at the moment. You can see it in the micro. You spoke about Bitcoin. Obviously, the last week or so has been a bit of a frenzy. We think a pause is likely due. You've seen it in the meme stocks. You've seen it in cannabis. You're seeing it this week, perhaps to a certain extent, in SPACs. All of that
stuff, Julian, is tangential. I mean, it's important. I get all that. Well, you know, Romaine Bostic's going to tell me it's Dow equivalency. Baloney. I mean, come on. The real market doesn't show the catharsis necessary to go down.
I totally agreed there, Tom. Basically, from our point of view, the speculative juices stirred on by liquidity, stirred on by the fact that the public is more engaged in investing than at any point in the last 20 years, is all supportive of the backdrop. Where we think you could run into trouble is later, likely from higher prices than we are now, when the economy fully reopens and those same traders, the buyers of short-dated call options, move away from their screens. But that's in the future.
Julian, you said take the Fed at their word. What does their word mean when it comes to asset purchases? I mean, at what point are real yields that are actually gas positive going to become a problem for them?
I think we're still away from that point. And frankly, if you look at how the asset markets have responded in the last couple of weeks, Chair Powell won't come out and say it, but he's probably not too terribly upset that you've seen the equity markets pause and sort of reflect on what's happened. And frankly, you know, the wish of the Fed is to redress the fact that asset markets outran the economy to the extent that it did over the last 9 months, and closing that gap with a stable equity market is a very, very noble goal, and that's where we are right now.
Julian, I just can't reconcile some of the complaints in this market right now. It just seems the Fed's stuck between a rock and a hard place. If real yields climb because growth expectations are better, somehow they're meant to step back in. They step back in, somehow they're fueling financial markets and financial market instability. Just how tough is this job for Chairman Powell right now?
Well, we'll say this. At least he doesn't have a boss who's harassing him in the public domain. So he's got that going for him. It has been a difficult job for the last 4 years. We are in extraordinary financial and monetary circumstances. Yep. And as we saw it earlier in the decade, it was very difficult coming off the zero rate bound. It took longer than expected. That's likely going to be the case again this time.
To be fair, Julian, if we had Chairman Powell version 2.0, I don't think his former boss would have been going at him in quite the same way. This is a very different Federal Reserve chair. Julian, great to catch up, sir. Good to see you. Julian Emanuel there, BTIG, Chief Equity and Derivative Strategist. And isn't that the story, Tom? The change at the Fed, we just keep going back to this. It is remarkable. Do you remember the chairman at the end of 2018 when we had that massive market rout? And you and I were at that Economic Club in New York address from the Federal Reserve Chairman as well. That period was so interesting. Yeah. We haven't reached the neutral rate. We're a far way away from it. This was when unemployment arguably could have gone a whole lot lower. And the lessons they learned then, they're applying now.
The lesson I learned was to duck when you threw the roll at me up on the podium.
Let me tell you, I was so far back, Tom, I couldn't reach where you were at the front of the stage there.
Look, John.
What happened to therapy?
This is it.
The roll bounced off Bill Dudley's shoulder. Okay, John, what's so important here is if we're in a range, SPX down less than 2% from its peak. That's not a correction. It's not a bear market. If we're in some form of technical range, what's the catalyst to get us out of this either way? All we're talking about with Gloom Abramowitz is the reasons we're going down. What's the catalyst to break up to new higher prices?
It's a mechanical story.
I don't hear that discussion.
It's a mechanical story. Look at the S&P 500. Break down SPX yesterday. Energy was up 1.6%.
Exactly.
The banks have been flying. It's all about weightings in the benchmark.
What's the catalyst to get up out of the range? I don't hear that conversation going on.
Well, I think you're either going to have massive leadership from elsewhere or tech participate at the index level, Tom. But more broadly, if we see a downdraft, you're not going to see high-yield spreads where they are right now. They're going to gap out. You're not going to see investment-grade spreads where they are.
We're not seeing distress.
Right there. You are not seeing distress. And I'll talk about the issuance that we've seen this week a little bit later in the program. Coming up, 8 a.m. Eastern Time, Bob Dole, Nuveen Asset Management, Chief Equity Strategist, a perfect guest for a very interesting morning. S&P 500 futures up 7. We advanced 0.2%. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
In New York with the First Word News, I'm Karina Mitchell. The House will vote Friday on President Biden's $1.9 trillion stimulus plan. That's according to Majority Leader Steny Hoyer. The president expects the package to pass by a narrow margin. The big question is the fate of the $15 an hour minimum wage. Two Democratic senators oppose it. Meanwhile, Senator Mitt Romney says if Donald Trump decides to go after the Republican presidential nomination in 2024, he'll win it. Romney is the only Republican who voted to convict Mr. Trump in both his impeachment trials. He says he expects the former president to continue to play a big role in the party. Over to Hong Kong, which has introduced its first stamp duty increase on stock trades since 1993, and that led to a broad market sell-off. Shares on the Hong Kong Stock Exchange fell almost 9%. It was their biggest decline since 2015. Mainland-based funds sold a record $2.6 billion worth of Hong Kong stocks. Golfing legend Tiger Woods is described as awake and recovering after a single-car accident outside Los Angeles yesterday. One doctor said he suffered significant orthopedic injuries. Woods rolled his SUV in steep terrain and had to be extricated from the vehicle. Police says there are indications he was driving at a relatively higher speed than normal. Now, Visa and MasterCard will reportedly raise swipe fees in April for some types of credit card transactions. That's according to Dow Jones. Merchants can end up paying about 2% of their customers' card purchases to the banks that issue the cards. They're already feeling the squeeze. The pandemic has prompted more online shopping where swipe fees can be higher. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. The economic recovery remains uneven and far from complete, and the path ahead is highly uncertain.
We're not there yet. That's the message coming from the chairman of the Federal Reserve, Jerome Powell, on Capitol Hill on day one of testimony. His semi-annual testimony continues in day two a little bit later this morning. From New York City this morning, good morning to you all. Alongside Tom Keene, Lisa Abramovich, I'm Jonathan Ferro. Your price action this Wednesday morning looks like this: 38.88 on the S&P 500. Up 10 points. We advance 0.25% after yesterday's losses on the NASDAQ. 6-day losing streak on the NASDAQ 100. We're positive now, just about up 40 on the NASDAQ. In the bond market, yields are higher. 125 is your spread between 2s and 10s, Tom. Your yield on a 10-year, 136.54.
John, very quickly here, I know you top-ticked it before you went to bed last night, went long sterling at a 142.40. It's ebbed away from that a little bit. Why sterling up?
Sterling's up, Tom, because we're going to reopen the economy in the UK, and Euro Sterling's down because Europe's going to struggle too. Euro Sterling with a break of 86 pence, just briefly a little bit earlier, Tom, and that's been a story for the last month or so. I just wonder the limits of that trade right now, given that Europe maybe have bottomed out in terms of that vaccination rollout. Can things just improve from here, and what does it mean for that currency pair?
I know. Well, we'll figure a gloom angle with Lisa here in a moment. Right now in the gloom of Washington, Kevin Cirilli joins us, our chief Washington correspondent. Kevin, I notice a jumble of political news and no real articles on the stimulus. Fold the present, honeymoon is over, jumble, Vlasic is now Secretary of Agriculture, etc. All this jumble into getting the stimulus done.
You know, 3 points. First and foremost, I'm hearing that there's likely going to be a House vote on Friday, and then that puts, secondly, the Senate in play for next week. And finally here, the minimum wage issue now at the forefront.
Where's that?
I'm struck by Senators Mitt Romney of Utah and Tom Cotton of Arkansas, two Republicans who came out now and actually saying that they would like to raise the minimum wage to $10 an hour over the next couple of years. But get this, they've juxtaposed it with some more increased regulations for workers who are here undocumented. So they've juxtaposed the immigration issue with minimum wage. Either way, it's a fascinating dynamic to have someone as conservative as Senator Cotton working with someone who's much more centrist like a Senator Romney.
I mean, Kevin, to me, it's remarkable that we can't figure out a constructive minimum wage model over different standards of living around the country, different costs of living, if you will. Why is this so hard?
Well, from the data perspective, as more people are working from home, it only raises questions about to your point, about how much salaries and whatnot are going to be able to be negotiated as a result of where they live. But to move beyond that, where the minimum wage issue now gets incredibly more polarizing is with Senate Budget Committee Chairman Bernie Sanders. And President Biden's going to have to referee this. Now, later today, I'll be speaking with the chairman of the House Budget Committee, the Democrat John Yarmuth of Kentucky, and they've really said behind the scenes that they are really just their goal to move this $1.9 trillion stimulus out of the House and into the Senate, but all the actions going to be in the Senate next week.
Meanwhile, you mentioned Mitt Romney, and he's very much in the center and has been, and he was not a supporter of President Trump. Can we talk about how increasingly of an outlier he is when you have actually Trump solidifying his leadership over the party? There was a story on the Bloomberg today talking about how a number of Republicans defected from the party following the issue on Capitol Hill, the insurgency. And as a result, the remaining Republicans are more in Trump's camp, leading to even more of an influence over the Republican Party. How are you feeling that in Capitol Hill?
You know, we talked about this for weeks, you know, whether it's my sources telling me he's going to play in a California recall or the Steve Bannon's floating that, you know, he could anoint someone to be Speaker of the House after the 2022 elections. I think the industry has to wake up and recognize that Donald Trump, the former president, is not going anywhere in terms of the shadow that he is going to cast over the Republican Party. And really, he's going to step back into the spotlight this weekend at CPAC, which is the top right-wing conservative conference that they're doing not virtually, but down in Florida this year. And so the Trump political orbit is, you know, they kind of joke about it. They think that it's not rocket science about how the former president is going to continue to be a role in Republican politics. And even to your point, Lisa, Senator Mitt Romney said publicly yesterday that he believes Trump would win a 2024 Republican primary if the election were held this week.
So the former president, changed the game with one country, Kevin, and you can take your own view on whether you think it was the right or wrong road to take. But the country I'm talking about is China. Now, for anyone familiar with the Five Eyes Intelligence Alliance, which comprises Australia, Canada, the United Kingdom, New Zealand, and the United States, this was in an editorial in the China Daily, the Global Times editorial, rather. It says the following: Five Eyes is today's axis of white supremacy. Something's brewing here, Kevin, between China and the rest of the world on the Uyghur community, human rights abuses, and I'm just wondering how a lot of this comes together in the months ahead.
The big story that I'm watching over the next couple of months ahead is the Olympics, and whether or not, and I mentioned this several months ago, but whether or not Democrats in the House and in the Senate start to put pressure on the Biden administration to back off of the Olympics as a result of China's human rights abuses and a host of other issues that you raised. Yesterday, President Biden signing some executive orders as it relates with the U.S. and Japan, given the chip supply shortage between the U.S. and as a result of China, rather. And then finally, Jonathan, to see Europe start to take a different approach as it relates to China is music to Secretary of State Tony Blinken's ears, because immediately they've been trying to get Europe and the United States cooperating more for how they handle with China.
Kevin, those are the China Winter Olympics, I believe, in Beijing. How close are they? I mean, it's sooner than we perceive, right?
Exactly, and it would be a major embarrassment for the Communist Party of China should there be countries pulling out. Right now, those calls with regards to China have not really started in the mainstream discourse, but they're there. There was at least one House Democrat just the other week who raised this issue, and it has been an issue that I'm carefully watching, because that will no doubt be a source of tension should those cries intensify between the U.S. and China.
And you're watching this on Sound On, right?
You already teased
Today we've got Chairman Yarmouth because, you know, it's stimulus week.
John, I just wanted to get that in.
I've got to do it now. Kevin Cirilli, Chief Washington Correspondent
Thank you.
and
I'm
host
very
of Sound
appreciative.
On Bloomberg Radio.
He did it more
weekdays
subtly today.
At 5 p.m. Eastern Time. So subtle that I actually missed it too.
Really?
He
said he was like, later on I'm going to be speaking with...
But did he mention the show?
No, but it was subtle.
Okay.
But it was there.
All right.
It was there.
You heard it, right, Tom?
Yeah, I went to the Faro School of Hype. It's great.
The Faro School of Hype.
All right, if you're talking Faro School of Hype.
It's Wednesday. We okay?
Friday.
Yeah,
Wednesday. Can we make it through to Friday?
You're going into deep planning, folks. So just so you understand, at 11 a.m. tomorrow, Wall Street time, Thursday, on Q, Faro says blow up the real yield.
That is true. I give Joel Levington of Bloomberg Intelligence a call, and we talk about credit a little bit, and then we'll spread out the conversation. Okay, coming up,
guests are good. Get
David Leibovitz, JP Morgan Asset Management, Global Market Strategist.
If I don't have Bob
This is what he sounds like, not me. Seriously. Equity futures up 12 on the S&P, and they get better guests in the bond market. Yields up by 2 basis points to 136.71. The team led by Jamie does a fantastic job. Let me just throw out that. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Why are you running around the world saving the world from hunger? Why are you doing that?
I want to live in a world that I kind of believe everybody is doing as well as my daughters.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio, and here's the price action this Wednesday morning. Good morning to you all. We advanced by 0.4% on S&P 500 futures. On the NASDAQ, 6-day losing streak. We take a little bite out of that. NASDAQ futures now up 0.5%. You're familiar with the story. Real yields higher, nominal yields higher, the curve steeper. Chairman Powell says it's a statement of confidence. Here's your statement of confidence. 2s, 10s, 30s in the bond market. Yields up, curve steeper. The spread between 2s and 10s throughout much of this morning, 125, the steepest since early 2017. Yields right now 136.88 on 10s, on 30s 223, and up 5 basis points. Switch up the board and let's talk about this. This is not late 2018. Brian Chapata putting a nice piece down on Bloomberg Opinion about that. For the chairman of the Federal Reserve, what's he seeing right now? He sees high yield spreads at about 320, and Tommy sees investment grade spreads still tight, and we can still come to market with about $40 billion of high grade debt this week. Now, Tom, that's critical. The primary market's functioning. Yields are low, spreads are tight. Yes, we're seeing a move in nominal and real yields in the Treasury market, but you're not seeing stress. You're just not.
Right.
And for the equity market more broadly, yes, some pain in tech, absolutely. Energy's flying, banks have been great. You are not seeing stress.
To what we talked to Julian Emanuel about BTIG, John, there's no catharsis, there's no stress. And I would note, John, as well, how NASDAQ comes back nicely. The VIX printing at 27 yesterday is in over 4 big figures since the Powell comments.
Now, as Lisa would say, you're not seeing stress yet. Yet. But you're not seeing it right now.
You're not seeing credit stress, certainly. Bankruptcy expectations have gone way down. A lot of this has to do with oil. But you're right. We're not seeing stress, period, full stop. There is no but.
There is no but. So we've heard from Chairman Powell. A little bit later, we'll hear from Vice Chair Clarida. That's happening at, I think, 1 p.m. Eastern time. So look out for that. With your movers, here's Romain.
Yeah, we really can't talk about what's moving today without really talking about what happened yesterday. Of course, the bloom coming off the rose of that growth and momentum trade early in yesterday's session. And then, of course, Jay Powell, as you guys have noted, came in with the water can and everyone sort of came back into the garden. Tesla was really emblematic of what happened yesterday. It was down 13% at one point on the day. It managed to sort of claw its way back up to roughly break even before closing out down 2%. It's getting bid higher here in the pre-market. While you were sleeping last night, Tom, we had Kathy Wood on Bloomberg Markets Closed radio and TV simulcast here talking about how she was one of the folks out there buying the dip. We did get a subsequent email from the ARK Investments, and 3 of those funds did actually load up on about 240,000 shares of Tesla.
Romain, that's so important. You've got to expand on that. On your conversation with ARK Investments, what is the definition of load up that you and your team learned?
Well, it was, well, 3 of her funds bought about 240,000 shares. We know that much. Of the 5 total active funds that she has, we're not sure about the other 2, but in her conversation, and we should point out Carol Master was leading that conversation for Bloomberg Radio, she made it very clear, Kathy Wood made it very clear that she saw this correction as healthy. She saw it as an opportunity for her to load up. We focus on Tesla too. We should point out, I mean, that's her largest holding in the ARK Innovation ETF, but she's really loaded up on a lot of those high flyers, PayPal, Square, Uber, a lot of these names here. She also talked about Bitcoin, Tom. These are some of the names that not only got her the attention and got her the gains, but she made it clear she doesn't think that growth, those gains are over.
Romaine, in the break, I was doing my taxes. Lisa was actually thinking about this serious issue. Do we have any understanding of what her cash holdings are right now?
She wouldn't, she was asked that question and she didn't say, no.
I was actually looking at the ARK ETF, her key ETF, which saw its biggest withdrawal in the last trading period recorded, that I believe was yesterday, of almost $500 million. It raises a question, Romaine, the sort of issue that comes up with a self-fulfilling selling cycle, because she does own a lot of these stocks. So if they go down, what cash does she have?
And we had a long conversation about just how diversified some of these funds are, really the lack of diversification. I mean, when you get to sort of the top 28, 30% of our holdings, I mean, it is a pretty small basket of high flyers, and that has to be a concern if we do find ourselves in a real and sustained correction, at least according to her, and as you would expect, she's still relatively bullish here. You can flip up the board here, too. I just want to bring you a couple other names to your attention here. There's interesting news crossing the wire just a little while ago. This regarding Didi Chongqing over in China. That's the ride-hailing service, saying they're going to make an expansion into Western Europe, including in the UK, France, and Germany, as soon as in the first half of this year. That's Uber territory, and Uber shares actually took an interesting dive down here in the pre-market on that news. TJX, they're going to report earnings in just a bit. I know, Tom, TJX, that's probably not your bag, probably more Lisa. You seem like a home goods kind of person. They're going to report. It is, absolutely, and it is like the big retail play here. Despite all the sort of talk about Amazon and elsewhere, TJX has actually been one of the outperformers here. And I just want to bring your attention to Bausch Health. This is a really interesting story here. Carl Icahn getting 2 board seats there. Of course, we learned a couple of weeks ago that he had taken a 7.8% stake. Remember, Bausch Health, this is actually the former Valiant. Of course, this was the big Bill Ackman Pershing Square play that he lost, according to Bloomberg estimates, about $4 billion on because of that fight over, of course, the acquisition spree that Valiant took on, and, of course, all the controversy about Valiant boosting drug prices in a way that some people thought was a little unethical. Kind of interesting to see that this is now a story bookended by Carl Icahn coming into this right now as they look to seek to shed off some of those assets and find some value.
Thank you, Romaine Bostic. As we give you the data, folks, here on our simulcast on radio and TV, we've got a 30-year bond out, 6 basis points. That's a huge move, 2.24%, rounded up. David Leibowitz is very aware of that at JP Morgan Asset Management. David, let's go right there where the data's moving. What is the signal of the long end of the curve, far out the curve, moving to a higher yield and reduced prices?
So I think what you're seeing is, as we get more and more evidence that the reflation trade is taking hold and the economy is really reopening here and then should continue to reopen over the course of the coming months, you're seeing assets begin to reprice. And, you know, frankly, below 1% on the 10-year, where the 30-year has been trading, those rates were reflecting a world where we were still in lockdown. And I think what you're seeing is that investors are finally beginning to wake up to the fact that 2021 is going to be a year where the global economy booms. We're getting more stimulus here in the United States. It sounds like policymakers around the world are going to remain accommodative over the course of the next 12 months. And I think, again, you know, fixed income was too rich for that type of environment. And so, again, a very healthy repricing and a pretty positive story when you take a step back and think about what's really going on here.
David, sometimes talking to clients is like therapy. You've got to keep them in the market, tell them why they've got to stay in the market. What's the conversation like right now?
So you make a great point about the wall of worry, and many have fallen off that wall when trying to climb it. The conversation right now is really about inflation and how the Fed is going to respond. I think the Fed obviously was spectacular in what they did in 2020 in terms of opening the credit facilities and re-engaging with fairly significant QE. But when we think about that shift in their framework to an approach characterized by average inflation targeting, nobody really knows what that's going to look like. It's very difficult to build expectations around how the Fed is going to respond. And so the biggest concern right now is effectively the inverse of what we talked about for the better part of the prior cycle. I mean, how many times did we have the conversation of the Fed wants to raise rates and the market says no way? We're beginning to see the opposite, right? The market is beginning to say, how long will the Fed stand pat are their forecasts realistic? That's really what's being called into question and dominating client conversations right now.
So dominating the conversations we had all year coming into 21, in fact, for most of the back half, was about the barbell strategy, having a secular growth on the one side, having a cyclicality on the other. Has that weighting, has that tilt, that emphasis shifted, David?
You know, we are increasingly adding more cyclical assets to portfolios, but the one thing we do recognize is that big bursts in cyclicality and big bursts in value tend to be relatively short-lived. If you go back to 1975, really the only sustained period of value outperformance was what we saw in the early 2000s. The rest of the time, it tends to be, you know, here today and gone tomorrow. So taking a bit more exposure on the cyclical side, we do think that those assets remain attractive on a relative valuation basis and should do pretty well given our expectations for the economy this year. But importantly, not running away from growth. If anything, rethinking the composition of our growth exposure. We still like tech for the long run. We still like healthcare for the long run. We just don't want to own those super growthy mega cap names that obviously performed so well in 2020. We think that those might tread water here in 2021.
David, we were talking about Cathie Wood earlier, the poster child for some of these high flyers, particularly in the tech space. And in her interview yesterday with Bloomberg, she said, the strongest bull markets I've been in are built on walls of worry. Do you agree? Do we have enough of a wall of worry to keep this bull market going?
Absolutely. I think, you know, when I was on a few weeks ago, one of the things we talked about was the fact that a pullback was becoming consensus, right? People are very skeptical about the durability of what's happening in markets. And to me, that's always, you know, a pretty positive signal. So I think as long as people are asking the questions, how is the Fed going to respond? What is inflation going to look like? What's the outlook for fiscal policy? Are we going to overheat? I mean, these are very relevant questions for investors to be asking at the current juncture. And I think at the end of the day, again, as long as we're viewing this rally with a healthy amount of skepticism, that suggests to me that it continues to have legs. We are not necessarily seeing, outside of certain pockets in the market, really that amount of it or that exuberance that makes us uncomfortable. We think everybody's still pretty measured, and again, that makes us pretty positive on risk assets as we look across the next 12 to 18 months.
David, thank you. Love how committed David Leibovitz is. The JP Morgan blue walls, doesn't that just work? Just works working from home.
It's a green screen.
Isn't that great?
It's gentle.
You think so?
Jamie's so proud. David, thank you. David Leibovitz there of JP Morgan Asset Management. Thank you. Equity futures up 12 on the S&P, up about 1/3 of 1% to about 38.90, Tom. And just a little bit of a bounce coming back through the NASDAQ after 6 big days of losses.
But John, well, just while we're talking there with Mr. Leibovitz, I mean, it's just real simple here. The 30-year bond is speaking volumes. There's no other way to put it. I'm sorry. It's price down, yield up. John, you know I loaded the boat on the 95-year Austrian piece. I'm down 23% in price. I may do a rotation into the U.S. 30 years so I can lose more money.
Isn't that ultimate duration risk? Isn't that just a perfect example of what people are worried about right now, Tom? Why they're shortening up duration, and worried about rate-sensitive parts of this market.
I will say this. We are experts at rationalizing equity markets. We're numb in the bond market. Right now, we're rationalizing price down.
Yields up 6 basis points to 224. Lisa on 30s, on 10s, about 138.
I want to just note that David Leibovitz was talking about how the gloom that you guys have disdain for is what's keeping this market going. That basically, if you have a healthy level of skepticism, that you end up being able to sort of understand, look around corners, figure out what your potential pitfalls could be, and then trade accordingly.
You know what's great, Lisa? Dr. Phil's text messaging me. We're not even using the phone anymore.
Yeah, what's he saying?
Lisa's the reason this
Lisa
market's going up. Lisa's the reason this market's going up.
Saying people look for the gloom so they can understand what they might be missing.
Coming up in the next hour, deep breath, Congressman Brian Steele, Republican member of the House Finance Committee. Looking forward to that. Chairman Powell on Capitol Hill. In front of that committee a little bit later. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg Television. This is Bloomberg Surveillance.
In New York with the First Word News, I'm Karina Mitchell. Today, President Biden will order a government review of U.S. supply chains. The goal is to end the country's reliance on China and other adversaries for crucial goods. But the process will offer no immediate solution for the shortfall of semiconductors that has delayed auto production at several factories. Meanwhile, Joe Biden and Canada's Justin Trudeau set aside differences over trade and other issues in their first meeting. The two conducted a virtual summit for 2 hours. They said their nations would adopt a unified approach towards the pandemic, climate change, and China. More fallout from that engine failure on a United Airlines Boeing 777. The FAA has ordered high-tech inspections of Pratt & Whitney engines that are used on 777s. A fan blade in the United jet's engine snapped, tore off another blade, and then the front structure of the engine. The British government has unveiled a $988 million plan to help young people catch up on lost learning due to the pandemic. Money will be used to expand tutoring programs and to help schools provide more activities over the summer. Schools in England are set to reopen March 8th. And Bitcoin went back over the 51,000 level today. The rebound follows a tough week for the largest cryptocurrency. It sank to 45,000 yesterday, reviving doubts about the durability of a five-fold rally over the last year. Bitcoin found some support from ETF superstar Cathie Wood, who said she's very positive on it. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We will look back at Bitcoin
Bitcoin as the poster child of speculation on the back of this rampant money supply. Now, that doesn't mean that I don't believe in digital currencies, but I do think that digital currencies will end up being controlled and issued by central banks as part of their strategy. So the big news to me will be when the Fed fully endorses the shift to digital currency. When that happens, I think Bitcoin's days are over.
James Bevan there of CCLA Investment Management. Looking at this market right now, Bitcoin 51K, up a little more than 6 percentage points. From New York City this morning, good morning to you all. Alongside Tom Keaton, Lisa Abramowitz, I'm Jonathan Ferro. For our audience worldwide, here's the price action. This Wednesday morning, up about 15 on the S&P. We advanced 0.4%. Just a little bit of a lift, even as we break out on 10-year yields, up 3 basis points. And Tom, as you've been talking about all morning, a breakout in the 30-year yield, up 6 basis points, a full 6 basis points higher to 224, and crude coming along for the ride at 62.27.
Yes, thank you.
On WCI.
I missed that on Brent crude. Now back to 66.07 on the print on Brent crude, 1.1% move. And again, I'm looking at currencies. They really haven't broken down from the range, but it's a fun day in the markets. A lot of nuance going on. On Bitcoin now, he has been definitive. Michael McClone is with Bloomberg Intelligence, our commodity strategist. And Mike, I'm going to cut to the chase and go right to where Secretary Yellen was a few days ago with the New York Times. Bitcoin, often used for illicit finance, semicolon, is inefficient. Describe the inefficiencies that Secretary Yellen's talking about.
I think she's missing the point. The number one vehicle for illicit finance is a $100 bill. So let's go over past that.
Ken Rogoff pointed that out in The Curse of Cash.
Bitcoin had moved up beyond that. But if you want to trade Bitcoin like the dollar, she's right. The dollar is much more efficient. But even our previous guest, John, said Bitcoin is not a currency. It's a digital reserve asset. It's not really, you can trade it, that's the good thing about it, but people who hold it potentially never want to sell it. I think it's this fact that most governments are going to CBDCs or want to go there, enhances the value of Bitcoin. Let's look at, and look from a digital asset standpoint, the number one traded currency in the world is Tether. It's a digital dollar. So to me, that's the key fact, is digitalization of money is enhancing the dominance of the dollar.
And I think Secretary Yellen would say the digitalization of money is occurring, but on Bitcoin as a gold equivalent, with the 3 Bloombergs you've got downstairs, what is the correlation of gold with Bitcoin right now?
Last year, it reached the highest ever on a 52-week basis. Now it's breaking away a little bit, but when Bitcoin reached 1 trillion gold bottom, I view them together as a bucket. They belong together. Because
really is a bucket trade.
I cannot analyze gold anymore without putting Bitcoin in there, because Bitcoin's replacing it rapidly. And what's the next iteration? And there's central banks hold a lot of gold. It might be prudent just to allocate some to Bitcoin.
Tiffany's going to have Bitcoin jewelry. I'm all over that.
Okay, let's hope Mrs. Keane likes that too. Mike, great to see you, sir. Rebecca Patterson of Bridgewater. Great to catch up with her a little bit earlier. And we talked about the volatility of the asset, the volatility potentially of a unit of exchange, and this volatility needs to come down. So, Mike, I'm trying to understand from your standpoint, what leads to lower volatility?
Higher prices. The key thing to look for about volatility is the depth of the market. So let's look forward, say 4 years, when we get to the next halving. Bitcoin will be much higher. It'll have much greater depth, and the volatility will head towards the same volatility as gold if the trends are example. And also a key factor about Bitcoin is two-factor model in terms of volatility, supply and demand. Supply is fixed for Bitcoin. Everything else, it's uncertain. So that's where I think you have to look forward to. If you want to wait for Bitcoin supply to go down, volatility to go down, great, but it's going to be from a much higher plateau with much more depth. And the question is, what will it take to trip that up? And I don't know what it is at this moment.
Wow, spoken like a true Bitcoin bull. There's a question, of course, also Rebecca Patterson talking about the regulatory framework, the idea that when there is more regulatory certainty, that's when Bridgewater will take a more serious look, in addition to less volatility in the crypto asset. What are some of the regulatory hurdles, the sort of thresholds that people are looking for with guidance with respect to any potential rules that could give people the sense that there is certainty there?
Well, when you mentioned Bridgewater, Ray Dalio did say he was fearful about the potential for banning Bitcoin a while ago. And they've tried that in other countries and it just moves to other places. And one thing to remember about Bitcoin, it might be the most unique example of decentralized capitalism on the planet ever, because it just migrates. As mining migrates to where it's cheapest and where it's used the most. And I think the key thing to think about regulation is. In the U.S., yes, regulate it, embrace it, and it'll put us ahead against the major adversary like China, who's trying to do a CBDC. And then let's look at regulation. What we have coming as far as a dangling carrot for the bulls is a U.S. ETF. Now, it's happening in Canada. It's just a matter of time here.
On the marketing side. If Yellen regulates Bitcoin, what does price do?
Depends on how she regulates it. If she tries to ban it, it'll just move someplace else. But I think more regulation brings in more institutions, and that's the major oomph right now. That's the major flows. Institutions are coming in this space, and all they need is the market to calm down a little bit, and they're going to be buying more. That's what I see, that's what we're hearing, that's what we're sensing. We're seeing that in most markets.
So, Mike, do you agree with Rebecca Patterson then? So if we get some form of regulation, it encourages the institutional buying, and that will lead to lower volatility?
I think it's more of a when.
Really interesting. Mike McClone of Bloomberg Intelligence, commodity strategist. Mike, thank you, sir. Looking at Bitcoin this morning, just south of 51,000, Tom, up a little more than 6 percentage points on a session.
Well, 58 to 48. I think we even got a 46 there for a while and a nice bounce back this morning. I can't make anything really technical of it, John. And if you say to me, what's fair value, I'm not smart enough to figure that out.
I would say look out for the banks this morning with yields up 6 basis points on 30s, up 3 on 10s, and a 2-year still pinned. The financials have had a really good ride, Tom, and the yield curve is moving in their favor even more so.
Well, yeah, and you've got green across the screen, even NASDAQ with a lift. Granted, it's a bounce, but I'm going to go back, John, to the hysteria over this sector, this sector, this sector. SPX is down under 2%.
Well, there's also a question here with the banks about the consumer profile, the idea that they have the money to pay back their debt, the idea that there is that strong consumer, which also edifies the financial sector. I'm wondering, though, about commercial real estate, and we really haven't seen a pricing out of what that looks like. When you start to see commercial real estate holdings actually get truly valued, what does that do to some regional banks in particular that have pretty high portfolio holdings?
I'm glad you bring this up, John. You saw HSBC talking about work from home, and they're going to take out 40-some% of their office space. I mean, how many of those do you need before it has an impact?
But we haven't talked about this for a while, have we?
No.
What the return to normal, the return to the city actually looks like. I know a lot of people that want to get back in the city. It's whether these companies change their footprint. But to change your footprint, Tom, takes a long time. They're long-term decisions. Yeah,
it changes your footprint, but I would say the employees are changing the footprint for a lot of companies, whether it's transportation or childcare, whatever. That HSBC announcement, I wonder how many more we're going to see of those given the pandemic improvement.
I was speaking to someone in the real estate industry, though, recently, and they were saying that people are up and moving to Florida with the bet that office jobs will not return to other places. They're betting that they have the flexibility to stay wherever they've moved. That is unproven, right? I mean, a lot of executives, particularly in the financial industry, have said, we want people to come back to the office. It's more efficient. People work better. And there's more creativity when people get together and have this.
Okay, but John, I know. Well, we could do this, John. We could move, John.
This is not a
John, we could move to Key West, where you were the other day, at the Golden Parrot, whatever it's called.
Sure.
We could do the show from the Parrot.
Why don't you go down there first?
I'll do a reconnaissance.
You go down there first.
I'll do reconnaissance.
Perfect.
With your combat pay.
You stay down there a little bit and we'll work something out. And then maybe we'll send a camera down.
Paul Singer's moving the shop down there.
We'll think about it.
You know, the guy next door to you, John, in the Central Park West or whatever.
Here we go.
There's like 3 units in your building for sale. They're all moving out.
For our audience worldwide, I don't live in Central Park West. I feel like only Tom does this.
There it is. I can see John's
on radio.
I can see John's unit.
Look, I've got oil still in my living room, John.
For goodness sake. That's a security breach. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
It's not surprising, given the issuance coming and the recovery coming, that bond yields are going to be higher. We're going to see the curve steeper.
We can see a situation where the U.S. economy grows faster than the Chinese economy in 2021.
As you see the economy further reopening, as you see a shift back towards services spending and a normalization in activity, a lot of those jobs can come back quickly.
What is the outlier event we could see in 2021? It's a blowout year for the economy.
The Fed may be underestimating the degree to which and the speed at which we're going to get back to normal.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowitz, and Tom Keene. Thank you so much for being with us on our simulcast, on radio, on television. And you know what? It's a churn to the market. I know you tune in for the markets, you tune in for the conversation. But John Ferro, right now we're tuning in for the 30-year bond yield. It's got a life of its own.
Up 6 basis points, Tom. Your 30-year at 224, and your curve steeper, steeper, steeper. 2s10s in and around 125 through this morning. 2s30s out all the way to 212, 213. Tom, the steepest curve we've seen, 2s versus 30s, going all the way back to late 2015.
Lisa, how does it fold over into the rest of the fixed income market, and for that matter, into the equity market as well?
Well, John touched on this. We're not seeing stress. This is actually leading to a new paradigm where people are less worried about higher yields when it comes in tandem with growth, as Jay Powell was confirming yesterday in front of the Senate. And you are seeing real yields creep higher. Typically, that has been looked at as potential for people to move away from risk assets into those havens. It is not happening, and that is what I'm looking at, Tom.
It's not happening, John. I want to correlate this in. Okay, folks, the far end of the curve, yield higher, price down. We've got a wonderful equity guest to reaffirm the equity markets here. But, John, what is your observation on the correlations?
The correlation to the equity market, financials up, rates up, the outlook for the economy better, banks rally. For the commodity market, commodities, crude, copper, rallying. What are the energy producers doing? Energy absolutely flying in yesterday's session. What's getting hit? If growth is less scarce, growth is less expensive, growth equity is not doing well. It's all very intuitive, Tom. It's all very orderly.
It's very orderly. That's right where I wanted to go. The catharsis isn't there. The sweat isn't there. John Ferro, I'm going to use Ben Laidler here, but many others researching on this. Is it a catch-up of energy, of the banks, of those, or is it a rotation? I don't really see a rotation.
Is it more durable? Is it more durable? And will the Federal Reserve ultimately allow this to continue? I think that's the question we've got to ask on the bank side of the trade, on the energy side of the trade, Tom. I think you've got to ask yourself what happens with the US dollar from here. It has been a weak dollar call coming into 21. And if that starts to go the other way because of US exceptionalism, it's hard to make the argument that the commodity market hangs in there and the energy trade does too.
Lisa Abramowitz, open question to you. You have had some caution here. Color the caution, Lisa, right now, because I don't see the catharsis yet in the pullback.
Well, the idea here is that the market in the economy is moving very quickly and that we are not getting it right. It is very hard to pinpoint the the exact growth levels. And we've seen a lot of the expectations swinging around violently, whether it's corporate earnings or whether it's economic growth projections. And the question is, what are we not seeing? Is it growth that's too fast, or is it growth that's too slow? And that, to me, Tom, is the big angst out there.
I'm going to go optimistic and say what we're not seeing is what we're going to see Q2, Q3, Q4, even Q1 22 on earnings. Robert Dahl is with Nuveen. He is the chief equity strategist, but maybe more than anyone on Wall Street, he has said you need to participate to win. Bob Dahl joins us with a reset on the equity markets. Bob Dahl, the opacity of earnings and revenue view forward, maybe I've never seen before, natural disaster, pandemic. How do you frame Q2 and Q3 earnings?
Awesome. We're going to have a great year for the economy and earnings, Tom. The opening up of the economy, the spending of the unbelievable amount of excess savings that consumers, that will unfold during the course of this year, and it will give us, according to our work, the best economy in 36 years here in the United States.
Credit Suisse shares that view. Bob Dole, many others do as well. What do you want to own?
So I think the shift is happening. Not that you want to sell all your large cap U.S. growth stocks, but value will continue to be growth. Small will continue to be big. Hard to believe. Small is ahead of big by 1,000 basis points already this year. And I think many international markets will beat the U.S. This is an environment that's very different from the last decade when economic growth was pretty mediocre. And so the most defensive economy and stock market in the world, the U.S., won the race almost every time, including the U.S. dollar. Some of that's going to shift a bit.
One of the reasons we're so optimistic about the outlook, increasingly so, was the start of November when we started to get some of the results of clinical trials of these vaccines, and these vaccines started to be rolled out. They're two-dose regimes. What we're waiting for now is the news around J&J, which is a one-dose regime. The FDA releasing briefing documents on J&J's COVID vaccine. This is available ahead of the February 26th advisory panel. Just to flag to our audience, Tom, just waiting for some details, some more headlines, some details coming out from there as we look at the path forward and maybe have an additional vaccine in the mix to get reopened.
No, we have additional vaccine in the mix, and you add them up 1, 2, 3. The mystery there, John, from the experts we've talked to, is they're learning as they go. We've got to have respect for that.
And this is the story, Bob. The way we will engage in this economy will change because we are reopening and engaging with each other in a way that we couldn't 9 months ago. Does that inform your decision on the companies you want to own and the companies you don't want to own?
Absolutely. You've got to be where the puck is going, and that's an opening economy. Look, I think the economy and the earnings call is the easy one. The stock market call's the harder one because we have a tug of war that will develop. Better earnings is an upward move for stocks, but you don't get that without modestly higher interest rates and inflation, which eventually puts a limit and could put some pressure on PE ratios. I don't see the PE in the U.S. stock market ending the year at 23 times where it is today. I think it'll be a little bit lower. I think earnings will win the race and stocks will be higher, but stocks won't keep up with earnings.
And this is something that John flicked at earlier, this idea that for a decade we saw the market drastically outperform the economy. Are we shifting into a new paradigm where the economy will drastically outperform the stock market and you see really laggard returns, even though you do have a true growth picture that is accelerating?
Absolutely. I still think this can be a good year for the stock market, but not great like the economy and earnings. What's great for the economy is not always great for the stock market. I mean, over time, there's a correlation, but you don't want you want mediocre growth that can last a long time. If we get these, some quarters of 6, 7, 8% real GDP, the whole question that you all addressed before I came on about the Fed will come back to the fore very quickly, and the market will start forcing the Fed's hand.
All right. How do you hedge in this environment, Bob?
I don't think you do yet. I still think you want to be out there with, as I said, the value, the smaller cap, and some international stocks. I think you need to, on weakness, be able to buy those stocks. I like the banks better than energy, but both are fine. But then where you're going to take the money from, it's going to be when you get those big up days in the growth stocks that are still pretty expensive.
Bob, let's go back to our Ute. Dow theory is really interesting. You and I followed it. Sometimes we agreed, sometimes we disagreed. How do you do Dow theory with a 5% plus real GDP? I mean, within the tragedy of the pandemic, it is morning in America. The oomph is unreal. How do you do Dow theory?
Yeah, it's very difficult. It's that works when conditions are more normal, but these are not normal times. The pandemic obviously was not normal on the downside, and this recovery is not normal on the upside. We do not have a playbook for this environment.
Thank you.
I learned painfully last year.
Bob, overweight cyclicals, consensus view right now, and looking at the data, rightly so in the minds of many. You mentioned something important, though. I like the banks over energy. Why, Bob?
Steepening of the yield curve, the stocks are cheaper, loan growth will pick up. I think there's been over-reserving in the banks on the back of the pandemic, so I think there are lots of ways the banks can win. Not that energy can't win as well, but there are too many external forces that I can't predict. I'd rather own a bank.
Not at the mercy of the commodity market, owning energy, owning the banks instead. Bob, great to catch up, sir. Bob Dole. Always brilliant to see you. Nuveen, Chief Equity Strategist and Senior Portfolio Manager. And that's what a lot of people, Tom, have got to think about at the moment, right? You look at the cyclicals, what do I want to own? Energy? Financial? Do I want that exposure to the commodity story and at the mercy of what happens in the FX market and a spillover from that? Or do I want to own the banks instead?
And frankly, with the sale of Wells Fargo Asset Management yesterday, this is a really interesting question 6 months from now, John. Do you want to be in active or do you want to be in passive? And that's going to be a raging debate.
Well, I think for the view of other people and not me, I want to be very specific about that as I try and get my words out. At the index level, Tom, and the S&P 500, on the NASDAQ, given the weightings there, if you're passive in those indices at the moment, there's a real risk that you miss out on a massive cyclical pull-up that we've seen. And that's the outperformance that Bob mentioned. Lisa, it's been 15, 16, 17 percentage points if you've been in, say, energy or the banks over the likes of the NASDAQ 100.
Yeah, and that's why there was a report out, or part of the reason why, this idea of active management, that actually hedge funds are expecting their biggest year of inflows this year in more than 5 years because people are looking for that active management. I want to go back, though. Bob was talking about how there is no model. Is there a historical precedent? What is the reference point to look at? And if we don't have a model, how do we view some of these historically high valuations when they're in this new time with no models really necessarily bearing out? I mean, Tom, that to me is something I wonder about. How do you invest?
I go to Steve Stanley earlier today where he talked about World War II and coming out and the dynamics out to the deflation of 52 and 53. There's some really interesting history there in the late 40s into the early 50s of boom and, you know, the struggle of the nation to come out of World War II. And that's the only thing I can come up with, Lisa.
Just to bring some headlines quickly from the FDA releasing their briefing documents on J&J's COVID vaccine. This report being made available ahead of the February 26th advisory panel. That takes place on Friday. Still waiting for some details from that, so we'll keep you up to date. Just to brief you very quickly, we are waiting for some details on that as J&J looks to roll out that one-dose regime, which could be the game changer for many people, particularly in Europe as well, Lisa, which has really struggled with the double-dose regime. Well, you want the single dose.
Yeah. Otherwise, how long do you have to wait, Tom? 6 weeks?
6 weeks, but it's a range. You can't wait too long. That's the real issue, Lisa, is that if you wait too long, it doesn't have the efficacy of the window.
Just to tease this a little bit more, they're posting their findings ahead of the advisory meeting on Friday.
Maybe.
They say that the vaccine is safe and effective, according to the FDA. The staff finding the J&J COVID-19 vaccine safe and effective. More still to come from this. From New York City, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. The House will vote Friday on President Biden's $1.9 trillion stimulus plan. That's according to Majority Leader Steny Hoyer. The president expects the package to pass by a narrow margin. The big question is the fate of the $15-an-hour minimum wage. 2 Democratic senators oppose it. Meanwhile, Senator Mitt Romney says if Donald Trump decides to go after the Republican presidential nomination in 2024, he'll win it. Romney is the only Republican who voted to convict Mr. Trump in both his impeachment trials. He says he expects the former president to continue to play a big role in the party. Over to Hong Kong, which has introduced its first stamp duty increase on stock trades since 1993, and that led to a broad market sell-off. Shares of the Hong Kong Stock Exchange fell almost 9%. It was their biggest decline since 2015. Mainland-based funds sold a record $2.6 billion worth of Hong Kong stocks. Golfing legend Tiger Woods is described as awake and recovering after a single-car accident outside Los Angeles. One doctor said he suffered significant orthopedic injuries. Woods rolled his SUV into steep terrain and had to be extricated from the vehicle. Police says there are indications he was driving at a relatively higher speed than normal. And the richest property tycoon in Hong Kong plans to list a blank check company in the U.S. Bloomberg's learned that a company backed by Li Ka-shing's family is working with advisors on the potential SPAC public offering. The family may seek around $400 million. Li is 92 and known for his timed bets on everything from real estate to social media. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We expect readings on inflation to move up. That's called base effects. That'll be a temporary effect, and it won't really signal anything. You could see spending pick up pretty substantially in the second half of the year, and that would be a good thing, of course, but it could also put upward pressure on prices. It doesn't seem likely that that would result in very large increases or that they would be persistent.
The chairman of the Federal Reserve, Jay Powell, staying on message on day one of testimony, day two, a little bit later this morning. From New York City this morning, good morning to you all. Alongside Tom Keene, Lisa Abramovich, I'm Jonathan Ferro. Here's the price action on a 30-year bond in America. We stare down the barrel and break 225. Up 7 basis points now, a full 7 basis points on a 30-year, Tom. Up 4 on 10s to 139. And a headline in the last 5 minutes, an encouraging one from the FDA. The FDA staff finding the J&J COVID-19 vaccine safe and effective. This is a one-dose regime, Tom, and it just fuels the outlook, a better outlook in America and beyond.
Well, we welcome all of you worldwide and across this nation on radio and television. And what you need to know is John gives you the data. John, it's about the 10-year yield moving just in the last number of moments, much more than that velocity of 30-year yield higher.
230s, 213 basis points, pushing 214, Tom. That spread wider by 6 basis points on the day.
Lifting the equity markets as well. Right now to the politics of the moment, it's very important to speak to a politician who actually had a payroll to meet and worked in a company. It is Charter NEX Films of Milton, Wisconsin. Brian Stile knows it well, the Republican from Wisconsin. Think Paul Ryan's old district. Congressman Stile, what does business need from Washington now? We've got to find a middle ground. We're going to get a stimulus. You're not in power. What does business need from Washington?
I think number one, we need to see our schools reopened. I talked to employers across the country. One of their largest struggles is finding workers. Our labor participation rate in the United States, just over 61%, is about the lowest since the Carter administration. The number one thing we can do to free up the labor market is to get our children back in school, allow a lot of these parents with young children to return to the workforce.
The vaccination program is clearly succeeding. Where do you perceive your district, the southern part of Wisconsin, where do you perceive at the end of this summer?
Hopefully we keep making progress. More and more folks 65 years and older are getting their vaccines. My mom and dad got their first vaccine in line. I think this is a positive sign. We're also seeing the numbers of total COVID positivity come down. That's positive. If we continue to see this, we're moving in the right direction. And again, I think this is further evidence that we need to get our children back in school. And I think that's the number one thing we can do for our economy across the country.
Okay, guys, ladies and gentlemen, I'm going to place a stop on profit for my 2 positions on British pound. Going to place stop on profit to 141.17. Just right here. Okay, so, right, I'm going to, I'll remove this one. Here I'm going to place a stop on profit. I'm going to sell this position and I'm going to sell this position. Okay? Here is the stop. It's what we opened today. Okay, let me adjust this price. Okay, so that's it. I'm going to sell at this level 2 positions.
$1,000. That's far in excess of what's actually needed. We needed to have this targeted to those people who've been negatively impacted.
Congressman, a lot of people are saying, though, look, borrowing costs are so low. Yes, they're rising. They're still historically low for the United States. Why not borrow now, get our economy running hot, and generate the economic growth that can pay down all this debt more easily and not potentially risk people staying out of work for longer? I mean, how much do you rely on that type of argument?
Well, I think these are the questions that we're going to have for Chairman Powell and committee today. The question is, are we going to overheat the economy? Again, we got to remember that over the past 12 months, Congress has allocated over $4 trillion related to coronavirus. Of that, $3 trillion has been spent. $1 trillion has yet to be spent. Adding another $1.9 trillion on top of that begins to leverage the future of our children and grandchildren, who will ultimately be held to pay for this debt.
What do you think constrains further spending, Congressman? What do you think it is? Do you think it is the bond market, rates? Do you think it is inflation? What do you think ultimately should constrain spending down in Washington?
I think you need to have a needs-based approach. So as we're looking at funds to reopen our schools, I'm supportive of getting the funds to reopen our schools today. But in a bill like this, we're looking at only 5% of those funds for education being spent this year. So that's a broad brushstroke approach rather than targeting the need of today, making sure we're rolling out the vaccine and reopening our economy safely.
So is it fair to say it would be ideological, it would be political and not financial, the constraints around what you think we should and should not do?
Well, I think what we've seen before is an approach to a needs-based approach. So when you saw Congress pass 5 coronavirus relief bills all in a bipartisan fashion, it was driven by the needs of the country. This bill that we're looking at, a $1.9 trillion bill that by all indications will be a party line vote here in Washington, D.C., is not focused on the needs of the country. It's focused on political priorities of the Democrats that they're trying to advance under the guise of coronavirus relief.
Do you feel powerless to stop it?
We're having conversations trying to win the hearts and minds of individuals and have them call their elected representatives. This is not a done deal until it passes. We need to make sure everyone understands what's in this bill so that they can call their representatives and see if we can put a stop to this.
Brian, the problem you've got, Congressman, forgive me, sir, is that the electorate like it, don't they? Looking at the polling.
Well, it's one thing to like free money. I don't have a problem with and understand. It's not hard to understand that people like receiving a check from the federal government. But at some time, we have to have an adult conversation that that check eventually comes back due. I'm very concerned about what our debt situation here is in the United States of America, approaching $30 trillion. And if we enter an inflationary period, payments on that debt will begin to squeeze important domestic spending.
Congressman, a conversation we need to continue. Thank you, sir, for your time. Brian Starr there of Wisconsin. Tom, an important conversation down in D.C.
It is, and you know, as he points out there, he sounded like a Democrat to me for a moment there, John. I mean, I think there's as you say,
not at the end.
There's huge popularity.
Let's be clear about
not
that.
At the end, not at the end. But I'm sorry, he's looking to move money into 2021, which I believe is what Speaker Pelosi wants.
I just want to point out that inflation is such a serious debate within even the economics profession. People have gotten it wrong, and that's the bet that really is underpinning this argument, right? I mean, John, if you think about it, he's basically saying if inflation does pick up, rates go up, and then it'll be tough to pay back. We don't know.
Let's be clear, right now there are no financial constraints to delivering this package. The Treasury market will absorb it. And I think it's always political, it's always ideological. We saw that with the previous administration. Their ability to try and shape this package, though, is just incredibly limited. And I think we're having the same debate, the difference between relief, Tom, and stimulus. And you hear the congressman there, and he's pretty clear that this goes beyond relief.
Joe Manchin,
John, I can't focus. I've lost 14% of my 30-year bond.
Is that where you were long?
I'm down 14%.
Is that where you were long?
Yeah, it was a little trade. It was an, you know,
coming out of cash.
You know, coming out of cash.
Building that duration into 21.
I'm down 14%.
Wonderful.
Thank you.
Wonderful. From New York City this morning, this is Bloomberg.
It's full faith and credit.
You can see here a live 3D hologram of myself integrated into a virtual environment, in this case, a spacecraft. Our software allows for the simultaneous capture of multiple people across different locations in real time. You can choose the point of view of the camera in real time. You can zoom in and zoom out to really control your unique experience. This capture can be integrated into games, teleconferencing applications, education platforms that are built with the standard 3D content creation software.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This morning is getting very, very interesting in the bond market. From New York City, good morning to you all. For our audience worldwide, live on TV and radio, here's the stock market. We pull up by about 0.2%. We bounce back by about 1/3% on the NASDAQ. 6-day losing streak coming into Wednesday for the equity market on the NASDAQ for big tech. Let's switch up the board. Here's the story. 2s, 10s, 30s. Yields up, curve steeper. On a 2-year, we go nowhere. On a 10-year, up 5 basis points. On 30s, up almost 8 basis points on a session now to 225.59. Adding fuel to that fire at the moment. The headline that came out just moments ago from J&J, from the FDA, saying that one-dose vaccine was both safe and effective. Yields up, curve steeper. What does it do to this one? Let's finish on this chart right here. This has been the story. The outlook for the economy better. Rates up, curve steeper. Fuel for this. The banks, the S&P 500 Banks Index, Tom, year to date, haven't even closed out February. We're up by 18.5%, Tom. What a ride it's been.
Big move there with the price of the 30-year bond down about 14%. I don't have that exact number, but you're really getting into some double-digit price declines out long duration. Right now on J&J, Sam Fazili joins us, Dr. Fazili with Bloomberg Intelligence. Sam, the heart of the matter of this is the search for simplicity. Peter Hotez at Baylor makes it very clear. What we need globally is a simplicity of vaccine delivery. Does J&J accomplish that?
Hi, Tom. So I don't think you can get simpler than the J&J vaccine. It needs very basic refrigeration, and it's one dose. So, yeah, absolutely.
When could we actually see it getting rolled out in the United States?
I think the dates that I've been hearing is in the next month or two. They did have some manufacturing issues, but certainly picking up rapidly going into the second half. So, but let's not forget that this vaccine, the U.S. has enough Moderna and Pfizer vaccines now to cover the entirety of the population, at least ordered. So this is a vaccine that really could make a difference to the rest of the world.
Dr. Fazili, let me ask you the question I've asked all of our esteemed guests in virology, which is from where you sit, Sam, do you look at the better statistics as an extrapolation forward into the spring of this year? Can you extrapolate to an optimistic outcome?
Tom, as you know, I would love to because it's also my life, but I am always wary of these variants that are circling, and I would love to think that they are not going to make a difference. And if you look at some countries where they have the B117 variant that was first identified in the UK, they've managed to get it under control with lockdowns and measures. So if we're careful, we can keep it under control. If we're not, and we go into big gatherings, etc., I think there's a risk that we might have another wave.
Sam Fazoli, thank you so much. And again, we're seeing it, folks, with the enthusiasm of the bond market, yield up and price down. 30-year bond, we're watching 8 basis points. That has moved through our simulcast nicely this morning. Neil Shearing with Capital Economics. Neil, the sustainability of what we see in real GDP, how far out do we sustain this above average economic growth off an end of the pandemic? Is it out to Q3, or can you take the oomph into next year?
I think, certainly given the size of the stimulus that's coming in the US, I think we can certainly take the oomph into next year. I think if we'd have had this conversation, in fact, we did have this conversation 4, 5, 6 months ago, it was how much lost output will there be permanently? Will we ever recover all of that lost output? Now the conversation is very much how quickly do we get back to pre-virus levels of output and the pre-virus trend, and may we even go above it? And I think the answer is we probably will.
Neil, 226 on 30s, up 8 basis points. The chairman says it's a statement of confidence. Do you share that view?
I think it is a statement of confidence, but there's perhaps a bit of a sting in the tail. I think you alluded to this at the start of the segment, which is the steepening of the curve. We've seen absolutely nothing at the very short end. The bond market, complete faith that the Fed's not going to move on the back of the fiscal stimulus plans that are taking shape. But I think that steepness of the curve reflects the anticipation of economic recovery, but perhaps also, too, that there might be some inflationary sting in the tail and that the Fed may ultimately have to move further ahead. And that, of course, is the big question. Is this going to be inflationary? Is it going to be consumer price inflationary, asset price inflationary? Could it leak into imports? And we see the effects on the US trade balance deteriorating and deficit widening. And I think at this stage, we can only really speculate.
What's your base case on how this asset purchase program at the Fed actually evolves in the coming months and quarters, Neil?
Well, our base case is that they hold the line, and I think they should hold the line. They should hold the course, and it continues. I think they'd be very, very slow to wind down the size of their balance sheets and announce tapering. We obviously the taper tantrum in 2013 is a bit of an omen in that respect, and I think they will have learnt lessons from that. So I think the Fed maintains a large balance sheet and it holds the course. I think they really, really want to see not just the whites of inflation's eyes, but the fact that it's not any pickup in inflation is not just a temporary blip, but it's sustained. And I think ultimately the Fed in particular, US policymakers in particular, are becoming increasingly comfortable with the idea that, you know what, inflation at 3%, we can live with that if it's the price to pay for other policy goals that we want with the economy.
Neil, what could we see that could cause inflation beyond 3%? Do you see any signs in the economy of something that could fuel that?
I mean, there are warning signs if you look. I mean, just look at what's happening in global supply chains at the moment. A global shortage of semiconductors. We've seen some price pressures emerging in supply chains as a result of that, and other demand for manufactured goods. Where we're not seeing any inflationary pressure, and Chairman Powell alluded to this yesterday in his testimony, is in the service sector, in the non-traded service sector, and frankly that's because it's largely shut or locked down. There's no inflation rather than inflation. I think you just can't measure it. So I think there's some warning signs in what's happening on the good side. Now, the question is, as I said earlier, whether or not the Phillips curve is, if it's not dead, then it's still pretty flat. My money would actually be on we get a moderately higher rate of consumer price inflation, maybe above 2%, 3%, something like that, maybe over the next 5, 6, 7 years. But we get a much higher rate of asset price inflation. It could be housing, we're seeing it already in equities, and that we get sort of froth in asset markets, and that's where we see some of the inflationary consequences of this.
So, Neil, this is why I keep coming back to this question of good inflation versus bad inflation. If you have the price of houses going up, if you have the price of going out to the grocery store, the price of filling up your car going up, but you don't necessarily see wages, certainly not in the service sector, which accounts for the vast majority of jobs in the United States, if you don't see those wages going up because you don't see inflation there, at what point do we lead to a really imbalanced situation that seems precarious and does not necessarily fuel the growth necessary to make that?
Okay, ladies and gentlemen, looks like we sold British pound at 114.17. when I will calculate our profit, I will show you everything on the screen, so you will see what it's all about and how much we made profit. For you guys, if you closed already, all of you who followed my trades, you closed your trade. It's all, like I said, depends on how much broker pays you per pip. I'll speak to you later. Well done. You did a good trade.
These pensions, 401ks getting amped up by asset price inflation, and that having an intergenerational inequality effect. So I think it's much more through the asset price channel than it would be through the consumer price channel, I think.
Neil, the salvation of this is cheap goods. There's an equity view that Pacific Rim will do well, the trade will rebound, maybe not back to the nirvana of February, but nevertheless, there'll be a rebound. Is capital economics optimistic on Asia getting back to what it was a year ago?
Well, if you look at Asia, some parts of Asia, it's already back to where it was a year ago. China is, Taiwan is, and that's partly the semiconductor boom that we've just talked about. So really, Asia's the region that has benefited, to the extent anyone's benefited from the pandemic. It's been Asia, and it's because we've seen this pivot in consumption patterns. We can no longer go to restaurants, we can't go to bars, we can't go to theatres, and we can't go to sporting arenas. So we're spending all our money on MacBooks and iPhones and cars and manufactured goods. And where are they produced? They're produced in Asia, and it's Asia that's benefited. We see that through global trade patterns. So I think the answer to your question is that yes, Asia will continue to lead the way. In fact, it is leading the way, and in many cases, it's back to where it was pre-pandemic. The question is that sustained once Western economies, developed markets start to open up and we start to get a pivot back towards services and restaurants open up and we start to spend more money there? I think at that point is when perhaps some of this outperformance from Asia starts to dissipate.
Neil, thank you, sir. Neil Shearing, looking happier since we last spoke to him. Out of London, yes. Fulham fan, Capital Economics Group chief economist. In its market right now, let's get straight to it. Treasury's lower, yields higher, up 8 basis points on a 30-year to 226 on 10s, up 5 or 6 basis points, Tom, to around about 140. It is 12 months since that Monday we all woke up after Italy had shut down and this market started to gap aggressively lower. It was the beginning of the sell-off. I think Jim Reed of Deutsche Bank mentioning that in his note this morning, Tom. It was the beginning of a huge move lower in bond yields as well. We're going the other way 12 months later.
I'm going to center tendency the range of the end of 2019, John. I'm going to center tendency that to 1.65, 1.70. So that's sort of the target back to pre-pandemic.
Anyone who was following Bloomberg TV about 2 hours ago will remember Tom Keene shouting, John Ferro shouting, Bob Michael.
Oh, yeah, it's a typical tantrum.
Guess who's coming up? Coming up on the open. Bob Michael of JP Morgan Investment Management, CIO, in about 20 minutes' time on Bloomberg Television on this bond market sell-off, which I've got to say is gaining steam. And Lisa, adding fuel to the fire. The headline out of J&J.
Yeah, I keep thinking that Robert Tipp is going to get in there. He said probably 1.5%. I'll start taking a look at 10-year Treasury yields. At what point do people start seeing this as a buying option?
I think we've got to ping the guys over at PGIM a bit of a message and find out whether they're buying the long end here. 10s at 140, 30s at 226. I'm being nice. Points. They've been dead on at the long end of this bond market for a long time. I just wonder if the buying starts to come in anytime soon. From New York City this morning, good morning.
Bob Michael's on at 9 o'clock.
This was fun, wasn't it? It's good. Do you want to tease your radio show?
I don't get Bob Michael. I'm going away for 4 weeks.
You're going away for a month?
Where, Capri?
If I don't get Bob Michael.
Oh, right. Okay, so you're not going to get him.
Tom's throwing a tantrum.
I just want to make sure that he follows through. Are you actually going away for 4 weeks then?
I'm thinking of it.
That'd be fun.
Vet Bill.
Lisa looks actually happy for the first time in 3 hours.
Oh, come on.
On a 10-year, we push 140. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Today, President Biden will order a government review of U.S. supply chains. The goal is to end the country's reliance on China and other adversaries for crucial goods, but the process will offer no immediate solution for the shortfall of semiconductors that has delayed auto production at several factories. And Joe Biden and Canada's Justin Trudeau set aside differences over trade and other issues in their first meeting. The two conducted a virtual summit for 2 hours. They said their nations would adopt a unified approach towards the pandemic, climate change, and China. And More fallout from that engine failure on a United Airlines Boeing 777. The FAA has ordered high-tech inspections of Pratt & Whitney engines that are used on 777s. A fan blade in the United Jet's engine snapped, tore off another blade, and then the front structure of the engine. Bitcoin went back over 51,000 today. The rebound follows a tough week for the world's largest cryptocurrency. It sank to 45,000 yesterday, reviving doubts about the durability of a five-fold rally over the last year. Bitcoin got some support from ETF superstar Cathie Wood, who said she's very positive on it. And three of Cathie Wood's exchange-traded funds posted their largest outflows on record. That's after a sell-off swamped some of the star money manager's biggest bets. Investors pulled $465 million in one day from ARK Investment Management's flagship product, the ARK Innovation ETF. Two other ARK funds had outflows totaling $321 million. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Why are you running around the world saving the world from hunger? Why are you doing that?
I want to live in a world that I kind of believe everybody's doing as well as my daughters.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
I do believe it's time that we will create our also the office of the National Director of Food and Nutrition at the White House, almost with a seat on the National Security Council next to the president, and making sure that we bring the resources of every single department. Food is more than the USDA.
We have all learned from the pandemic, and we will never be the same after this pandemic is over. Jose Andres there of World Central Kitchen. Of course, David Rubenstein Show peer-to-peer conversation tonight, 9 p.m., and Mr. Rubenstein joins us right now. David, thank you so much for doing this interview, because Lisa and I have viscerally seen the hunger on the streets of New York. How are we different in this pandemic? How are we different after this pandemic, according to Mr. Andreas?
Well, his view is that it is amazing that in a country as wealthy as ours, we don't really distribute food very well in a situation like this. Who would have thought you'd have gigantic food lines in Dallas or Los Angeles with people who are middle class not having enough food? So he's worried about it, and what he'd like to do is to have a White House advisor on food near the president who can really focus on the food distribution and make sure that people have appropriate types of food. As you know, he's a great chef, a world-class chef, but he's spending most of his time now on humanitarian types efforts, including feeding people around the world when there are tragedies in their countries.
We have obesity in America because food is so darn cheap. If I go to aisle 5 of my fancy Whole Foods, there's 14 choices of rice, 13 choices of mustard. How do we translate that to an impoverished world?
Well, that's the problem. In Whole Foods, which I think is great, is terrific for people that can afford it. But many people in this country and around the world really can't afford something like that. And it's a sad situation where when you have, even in this country, a crisis like the pandemic, you have to feed people who normally have food and access to food. We don't really have a very good distribution system for a pandemic like this.
Well, David, it goes beyond just the pandemic. I mean, I'm thinking about food deserts, and that was definitely raised as an issue, as people can't necessarily even buy easily some of the fresh foods that you're talking about. You said appropriate foods, right? It's not just anything to eat. It's something that will actually be healthy. I mean, what is Jose Andres?
Okay, traders, just wanted to show you this trade. As you can see, from top to stop on profit, we made £6,000. Yesterday we purchased British pound. We have a loss, so we don't sell on loss. We purchase at a higher price. After calculation, I decided to place stop on profit at 141.17. Total calculation here is we lost from first trade £4,000. From second trade we made £6,000. Total we made £2,000 just in less than 24 hours. Okay, I'll speak to you later, guys. Stay safe.
Is to live a healthy and happy life, and one of the best ways of doing that is eating well and eating healthy, and he's focused on that. It's an interesting phenomenon that he could make a lot of money as a restaurateur. He has about 50 restaurants. He's closed many of them because of the pandemic, but he's focused on his World Central Kitchen, which goes to any place in the world that has a starvation problem.
Solomon at Goldman Sachs is speaking right now at the Credit Suisse conference, and he touches upon something that is immediate. With your years of perspective, with the hundreds and hundreds of companies that Carlyle Group has advised, where are you on this shift to work from home? HSBC says they will trim their office square footage. Mr. Solomon says remote work is not a new normal, just an aberration. Your thoughts, please.
I don't think it's likely that we're going to go back in the next 5 years or so, or even 10 years, to the work pattern we've had before. It's amazing that in 1 year we've learned that we can work at home and work remotely. So I think most employers will probably be happy to have their employees work remotely for some time. I think there is a value to going to the office, seeing your colleagues, particularly for younger people who need mentorship. But I think we've changed the way we work dramatically and probably forever as a result of the pandemic.
David, congratulations on getting your first shot this week for the vaccination. I know Tom Keene has had both of his, and it's a very exciting time sort of seeing the light potentially of a normal world emerging. When do you hope to get back to the office to see your employees there with a bit more normalcy?
I think it's unlikely that employees at financial service firms and office firms of the kind that I work at are probably going to go back in any real measurable way until the fall. and it may not even be until next year. Nobody knows for certain. But I don't think anybody is thinking they're going to go back 5 days a week the way they did before, or like me, travel as much as we did before. You can do so much with this kind of technology. So I think the days of my traveling 240 days a year around the world are probably over.
David Rubenstein, thank you so much. Stay healthy, and we appreciate your guidance. Carlyle Group co-founder and co-chair, peer-to-peer conversations, always enlightening, on Bloomberg Television tonight at 9 p.m. in New York. Tom, a huge issue facing everybody, especially after we saw those lines as you were talking about. But right now, we need to shift our focus to the markets.
Well, the markets are moving. There's just no other way to put it. We've got red on the screen. Equities actually pull back, and that is important. Lisa, this full faith and credit move, I don't know what to do. 10-year, 30-year. I'm going to go 10-year with a round number over 1.40.
Yeah, well, what you're looking at is the long end continuing to sell off, yields going substantially higher, leading to some of the highest yield curves, which is a key measure of going forward and potential optimism, spreading, widening out, at least in one case, the most since 2014. I do wonder, Tom, how much is this people expecting a better economy, and how much is this people seeing that the Fed maybe will not step in and will allow this yield curve to continue to steepen without, taking any serious action?
I'm going to go on it is a reset on vaccination. We've had a number of guests and analysts make it real clear there's a direct correlation here between the good news, J&J out an hour ago. That's furthered what we already saw this morning. And again, Lisa, very few people handle price decline. 10-year yield, 10-year price, and I'm down maybe three big figures, 3-4% here through the month of February.
Yeah, but here's what I'm really struck by. There still is a dissonance between markets that are full out ahead of this potential for overheating, and they're looking toward a real booming economy, and economists that are not full in on that yet. They still see the idea of being in this slow growth kind of paradigm, and I do wonder who's right. Right? I mean, where does that gap get bridged?
Well, you can have two different views on the economics and on the markets as well, and they could go either way for all different reasons. I would again go to the immovable force of improving pandemic data, and I'd buttress up against what Bob Dahl said earlier, which is you're going to have a given economy, and it's going to deliver a given earnings and revenue, and that's a tug of war in equities right now. 27 VIX down to 24.32.
And I will just say that the reaction function in equities is going back to what we saw earlier in the week. Right now, we are seeing stocks roll over the NASDAQ, seeing a bigger decline in the futures market as we see those 30-year and 10-year yields shoot higher. So that correlation of higher yields and the pace at which they're rising, Tom, leading to lower equity valuations still seems to be holding this Wednesday morning.
Chairman Powell talking, and importantly, the Vice Chairman, Richard Clarida, will speak early this afternoon. We will get perspective on Bloomberg Markets. Alan Blinder, the former Federal Reserve Vice Chairman, and of course at Princeton University. With markets on the move, again, the 10-year yield, it's an 8 basis point move of 1.42%. These are new numbers. I got to get used to this. Thank you for listening on radio, on television. Stay with us through the day.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now. 30 minutes until the opening bell. Equity futures rolling over, bond yields rolling up. Your 30-year at 227 and up 9 basis points. Let's get straight to it. We begin with a big issue. Chairman Powell doubling down.
Keep monetary policy accommodative. It needs to continue to be accommodative. Support and stability. We will not tighten monetary policy. We're committed. We are strongly committed to using our full range of tools, bond buying program, federal funds rate, our holdings of Treasury securities, agency mortgage-backed securities. We do have the tools we need. The economy is a long way from our employment and inflation goals. Trust, that inflation is going to be under control. This is not a problem for this time. That's what it will take for us to begin to moderate the level of purchases. Substantial further progress. Until substantial further progress has been made, the job is not done.
Well, this bond market can smell that substantial further progress. So let's bring in the team. Bloomberg's team, Michael McKee and Sarah Ponzek. Mike, a green light to push yields higher?
Maybe. That wasn't what he was signaling at this point. He kind of would like everybody to just sit tight at the moment. Sometimes the chairman is talking to members of Congress, and sometimes, well, pretty much all the time, he's talking to markets. And his message, steady as she goes, no change, we are where we are, pick your cliche. Unfortunately, the question is the market listening? Powell's message was that the economy is going to get better in the second half, and we are going to see price pressures go up, but, and this is the quote that he would like the markets to take away, the economy is a long way from our employment and inflation goals and is likely to take some time for substantial further progress to be achieved. In other words, don't move rates because we're not moving rates. You look at the market reaction this morning, though, and you wonder if traders are listening or if they even believe. I mean, bonds falling again today. Now, one argument is that fixed income is just repricing for a different economy. We are not in the half percentage point 10-year yield economy of last August. And remember, we came into 2020 at 1.9 something. So we're not even back to where we were before the pandemic started. The other side of that trade, however, is that, and it's still a minority, but they have influence, is that the Fed may be getting behind the curve, and what if Powell is wrong? They're looking at the forecast for consumer and business spending this coming year, and they're fairly strong. Business spending up around 9% and about 5% for the consumer side. A lot of pent-up demand unleashed, aided and abetted by a huge stimulus program. What does that mean? Well, Stephen Stanley at Amherst Pierpont thinks that instead of the last business cycle, we should be looking back to the 1940s, at the end of World War II. Remember, the Fed had pinned rates low, and inflation and growth were both very high at that point. However, if asked, and if anybody does today, Powell, on the other hand, might say, yeah, but look at what happened after that. Throughout the rest of the 50s and much of the 60s, as John remembers, growth was strong and inflation was about where it is now. So it'll be interesting to see if he can convince the markets today. Probably not going to say anything on the stimulus programs, et cetera, like yesterday, but he'll be speaking directly again to people on trading desks.
Mike, thank you. Chairman Powell later. Vice Chair Clarida coming at 1 p.m. Eastern time. Look out for that. The main story this morning, let's get the bond board up. 2s, 10s, 30s, and look through it together. Your 2-year yield up about a basis point. Your 10-year yield up about 6 basis points. Your 30-year up 9 to 227. The yields are higher, the curve is steeper, and Chairman Powell thinks this is a statement of confidence in the outlook. And for many bond investors, that is exactly what it is. Let's get more with Sarah Ponzek. Hey, Sarah.
Hey, John, this is absolutely the story of the morning. Yesterday, markets seemed to listen to Powell, take solace in his comments about the Fed not being ready to ease or stop easing, I should say, or reduce accommodative policy. So with that, in the middle of the day yesterday, we did see the 10-year yield move below 133 again. We saw the equity market really reverse much of the move that we had seen earlier in the day to close positive for the S&P, but today that's not the case. You see an extreme steepening in the 2s, 10s curve right there, now at the steepest level since 2015. This month alone, we have seen a widening in the 2s, 30s curve by more than 40 basis points. That is the most for any month now since 2009. So over a decade, but that was also a period in which we were emerging from the global financial crisis. But if we take a look at what's going on this morning, your state of play, because earlier today, yields weren't moving too much. Now you see the 10-year above 140. You see equity futures really just rolling over after holding in the green after the reversal that we saw yesterday. And let's just talk about the reversal we saw yesterday in the NASDAQ 100 and high growth areas of the market, because the NASDAQ 100 yesterday, for a time, we saw it down 3.5%. We saw at a time all of those losses were erased. That was the first time that happened since last February. You're looking at that 2-day move right there. What a roller coaster ride it has been. But today we are seeing NASDAQ futures headed lower once again, John.
Sarah Ponzek, thank you very much. Story of this morning then. Equity gapping lower in the last 30 minutes or so off the back of a big move in the bond market. I want to get straight to Bob Michael of JP Morgan Asset Management to talk about this. Bob, always great to catch up with you, sir. Your 10-year yields high, your 30-year yields much higher. What's your response, Bob?
Well, I think there's a lot of confidence that the Fed is doing its part with all the other policy responses to ensure that the recovery continues to accelerate. And we need to remember, it's not just the Fed. If you look at the healthcare policy response, infection rates are down and vaccinations are accelerating. If you look at the fiscal response, that $900 billion in stimulus at year end is still working its way through the system, and we may have another $1.9 trillion coming. And the Fed has told us they're a long way away from their employment and inflation goals, so they're leaving monetary policy where it is. It would be interesting to think about where the 10-year would be if they weren't doing $120 billion in purchases per month.
But what do you think the limits of the sell-off are then? You've been looking for a range of 1.6 to 1.9 on a 10-year. We're at 140 right now. I assume you think there's oxygen left in this.
No, I think we've gone far enough for now. I wasn't looking for it to all come at once. I think that would be highly disruptive to financial conditions. And I think the Fed is on this journey to a path that's higher and looks a bit normal, but they don't want to do it all at once. I think at some point, foreign flows, cash out of money market funds, and the Fed's own buying will stabilize yields somewhere between, call it 1.25% and 1.38%. I think we're coming towards the end of the sell-off.
The point you raise is really important, Bob. The competition for capital, the competition for flows, the yields start to bite. At these levels, at 140, you think that gets it done?
For now, I mean, there's a lot of disconnects in the market right now. We're looking at a monthly backup in yields of 30 or so basis points. The last time we saw that magnitude of move was November 2016, so right after Trump was elected. So that's one thing to keep in mind. The second thing is your own Bloomberg economics forecast. 6 to 7% GDP when you look at the full year, assuming that a large percentage of the stimulus gets through. And the third thing to look at is this 1 3/8 yield we're at. It looks high today, but that was actually the low reached in July 2012 and July 2016 after the financial crisis. So we're a long way from anything that looks rational. And the Fed is doing a pretty good job of ensuring the cost of recovery is pretty low for a while.
Bob, many people looking at the spread between 2s10s, 2s30s this morning. Can we just sit on the spread between the German 10-year and the US 10-year and just how far wide that spread can actually go in your mind?
Well, I think it can go a bit further, maybe another 50 basis points or so. And I think that's mostly because the U.S. is on a path to accelerating economic recovery and a faster closing of the output gap. I think there are still some structural problems in Europe, and you still have a central bank that's committed to keep rates low for a long period of time and has a lot of tools that they can intervene in the market and keep market rates down there.
Bob, what kind of growth numbers are you looking for? On the ECFC function on the Bloomberg right now, 5% there and thereabouts on real GDP is the median forecast right now for 21. For 22, it's 3.6. Morgan Stanley much further north than that at 6.5 and 5, respectively. What are you looking for, Bob?
Well, we're expecting that a fair percentage of this $1.9 trillion stimulus comes through. Is it 1.7? Who knows? I think the other thing to remember is that the Democrats control a second budget reconciliation process at the end of the year. You could see a big infrastructure spend coming out of that. So we think we're going to clear 6% for full year GDP, and the stimulus will get through.
Bob, something changed from where we were 9-10 months ago. I remember the conversation, you remember it. I was at home, I think you might have been at home or in the office, and we were having this chat about how long it would take to close that output gap, and you said it would take a long, long time. What changed for you, Bob?
Well, what changed for us is that central banks embrace the role of modern monetary theory. And it seems to be a tool in their kit going forward where after a crisis, governments accept that their role is to borrow and spend and generate some GDP and fiscal transfers to keep things afloat. And central banks view their role is to print money and buy that debt so that the cost of funding a recovery doesn't get out of hand. This is quite a way away from where we were during the financial crisis when everyone was talking about austerity.
Bob, great to catch up, sir. You're going to be sticking with us. Bob Michael there of JP Morgan Asset Management. In your market, yields are higher by almost 10 basis points on 30s to 228, on 10s to 141. Some extra fuel for the fire coming from J&J in the last hour. The FDA saying that vaccine, that one-dose regime, both safe and effective. Yields gapping even higher off the back of that. 2s10 spread, the widest we've seen it going all the way back to 2017. I think we're pushing 2014-15 levels now on 2s30s. The banks, the one to watch at the opening bell. Let's get to the market desk for more. Here's Abby.
John, let's start out with that J&J story that you were just talking about, because about an hour ago or so, we had a risk-on tone in J&J, the news that they do have this safe and effective one-dose vaccine, really adding to that tone until you had that big backup in yields over the last hour. Now, on this news, though, J&J up 1.5% near session highs. Moderna also rallying off of this. You have the reopening trade, the airlines, the cruise lines, all travel and leisure higher. However, where we now have the pain trade is the pain trade over the last few days, except for the close yesterday. And of course, I'm talking about big tech. An hour ago, Apple was up more than 1%. Apple is now back below its 100-day moving average, technically broken, down on the day. Microsoft, Amazon, Facebook, all of these names have reversed on this backup in yield, calling into question valuation. Investors simply not tolerating it. Again, some of these stocks, John, technically broken. It seems as though the selling may just continue again on this backup in yield.
Abby, thank you. This bond market, maybe not broken, but some cracks in the trade that delivered big last year. Duration, suffering, yields higher by 10 basis points on a 30-year, up by 7 basis points now on a 10-year yield. The conversation on the bond market as Chairman Powell faces day 2 of testimony. We'll continue that conversation with JP Morgan's Bob Michael and Greg Staples of DWS. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The thing we always get asked about is asset prices, but they're only one thing. Ultimately, what you want is a situation where movements in asset prices do not disrupt the broader financial system. I wouldn't comment on any particular on bubbles. You know, we're not. No one can really identify them. They're, you know, for any particular asset, even now, you know, people have different perspectives.
That's one way of dodging the question. Fed Chair Jay Powell brushing off bubble concerns, instead seeing the recent run-up in yields as a statement of confidence in the recovery. Yields continue climbing, up 10 basis points on 30s to 227, up about 7 basis points on 10s to 141. With the story, here's Kaylee.
Well, John, I don't think anyone is going to argue that the Treasury market is in a bubble because the selling pressure is continuing, particularly in duration. Through 140 on the 10-year, as you said, the 30-year yield up about 10 basis points. So they're selling in the Treasury market, but there has been rabid buying in other areas of the market. That is the frothy bubble concern areas that people are pointing to. The likes of Bitcoin up 70% so far on a year-to-date basis, as well as SPACs. That boom seemingly never ending. The appetite for that issuance can't stop. But it's noteworthy, too, the outperformance in the credit market has been in the riskiest areas of credit. The junk-rated debt is outperforming its peers. Now, of course, the finger gets pointed at liquidity for this. Senator Pat Toomey, early on in Powell's testimony, says, do you think there is a link between the liquidity the Fed is providing and these unprecedented asset price levels? And Powell basically said, yes, there is certainly a link, that there's many factors involved, but monetary policy is one of them, with the Fed's balance sheet now sitting at $7.5 trillion. And of course, the Fed has been quite active in the credit market as well, John. That is in part why we have seen yields come in so dramatically since last March. Now investment grade yields sitting at just 92 basis points above Treasuries. So the question now is whether valuations in credit are going to start to come into question, if we are going to start seeing some of the selling in credit bleeding over from the selling we are seeing in the Treasury market, John. Again, the long end of the curve, massive selling, specifically in 10s and 30s today. The 10-year yield through 1.4% in today's session, John.
Kelly Lyons, thank you. Thank you very much. I think Kelly brings up a really important point about the competition for capital here. When does it start to bite, the move in yields elsewhere? At the moment, you're not seeing signs of stress. Don't see it right now. Doesn't mean you won't see it, but I'm just saying you don't see it right now. This week alone, we're set to get another $40 billion of high-grade issuance in the credit market, and that credit market, that supply has been taken down really quite well. In the equity market, it's a mechanical story, isn't it? Just look at the energy sector yesterday, absolutely flying. Commodities doing nicely. Banks year to date doing really well. Higher yields, steeper curve, better outlook. Banks rallying. The story this morning, yields up 10 basis points. Abigail will run you through the sector price action a little bit later. It's the rotation that continues. And in Chairman Powell's mind, I think many people agree with him, what's happening at the long end is a statement of confidence in the outlook, but also maybe in the Federal Reserve as well. I think Joe Weisenthal wrote about this earlier this morning. The Fed is going to anchor the front end. The flexibility is further down the curve, on 10s, on 30s. And if you're pricing in a better growth outlook, more inflation, isn't that the objective of the Federal Reserve? Let's get to the team. Greg Staples of DWS, JP Morgan's Bob Michael still with us. Greg, do you think this is what the Fed wants to see in the Treasury market?
I think they want to see increasing higher rates because I do think that's an indication that the economy is opening up, but I don't think they want to see it to the degree that it's happened over the past week or 2 weeks or even since the beginning of the year. 30 to 40 basis points in the past month is a little bit too much for their taste.
The shift away from break-evens to reals, the move we started to see from inflation expectations to real yields in the last week, Bob, how do you think that plays into the Fed's thinking?
I think it plays in to some extent. I think they're preparing for a spike in inflation over the next couple of quarters. It's very possible we could get into May, June. Core CPI could print 2.7%, and you're looking at a dramatic negative real yield if you're down around 1 3/8. Even at 170, you're only back to a minus 1% real yield.
You sticking with the risk trade, Bob?
Absolutely. And look, you know, we talk about, does the Fed like to see the steepening of the curve? Yeah, to some extent. Let's remember, they've got a couple tools in there, and withdrawing each of the tools has a very different reaction. If they withdraw quantitative ease, then the curve will steepen a lot because they're the thing that's in there with quantitative ease, trying to keep it as flat as it is. And I know it's been steepening. So that, withdrawing QE creates curve steepening. If they start to hike rates, that creates curve flattening because now they're starting to lean into the front end and try to lean into growth and inflation.
It's a really good point. Greg, how do you put these two things together? What's happening in the Treasury market and how you allocate capital and fixed income to the riskier assets?
I think actually the Fed's got itself into a bit of a tough position. I mean, he's got quantitative easing at 120 billion per month, and he's got Fed funds stuck at the lower bound, and he's saying that's not going to change for a while, even though the dynamics of the economy have changed a lot. I think that means the Treasury rates continue to go up. I mean, I think we'll probably get a pause here, but the general direction is fairly clear. But the underlying fundamentals for credit, for example, are still pretty good. You talked about down and high yield. There's a lot of companies there that are in materials. They're in the energy space, and with the increased stimulus and the increase we've seen in commodity prices, I think those sectors are actually seeing their fundamentals improve a little bit. That's a place where we're actually looking and finding a good place to deploy capital.
That's the credit risk story, and Bob's on board with that. The focus has been on duration risk, and people have been shortening up duration over the last few months. And looking at the moves we've seen in the last few weeks, that was the right trade. I just wonder, Bob, how you start to think about adding a little bit more duration as these moves play out.
Well, we're starting to see flows come back into our market. I think when you look at foreign flows, certainly out of Europe, there have been flows into the U.S. market. We expect to see them out of Asia and Japan in particular. And then when you look at plan sponsors, pension funds with long liabilities and insurance companies, the backup in yields here, particularly in the 30-year, gives them a chance to get back into these markets. So as I said, I think we've gone far enough for now. We'll pause here and see how things play out over the next couple months.
A chunky 229 we're pushing now on a 30-year, chunky relative to what we have seen in the last 12 months. Greg, I want to finish with you, sir, because Vice Chair Clarida speaks a little bit later. Governor Brainerd as well, and you believe Governor Brainerd is the future Fed chair. What are you listening for?
I'm listening. Well, I think that Powell might have put himself in a little bit of a difficult position. Like I said, he's got to be a little bit more nimble. He's right now locked himself into a position, and I think the economy is changing, and I'm not sure he's going to be able to change with it. Brainerd is a potential person who could be leading the Fed in 2022 if Powell doesn't extricate himself from the situation fairly delicately. So it's something I'm watching. I think he's in a tough spot.
You expecting a change of script a little bit later, Bob?
A change of script in terms of Fed chair? Oh, I think absolutely. I think it's a very valuable position. And I don't see the Democrats supporting a previous candidate's choice. I think they'll put somebody else in there.
Bob Michael, good to see you, sir. What a morning for it. Bob Michael there from JP Morgan. Greg Staples from DWS. Yields are higher by 11 basis points on a 30-year, on 10s up by about 9 basis points. So the Fed arguably stuck between a rock and a hard place. We've got two pieces of criticism coming from two different directions at the moment. On the one hand, yields are higher and some people think the Fed should step in. On the other hand, we've been talking about froth for how long now? The last several months, and people believe the Fed is just exacerbating the problem. So which poison would you like? From New York this morning, up next, the analyst action you need to know. That'll be next in our morning calls. And later, it's 1 year since the start of the COVID-fueled market rout. That conversation still ahead with Morgan Stanley's Dan Skelly. From New York City this morning, good morning. Equities pulling back just a little bit, down 13 on the S&P, off a third of 1%. Yields pushing higher by quite a lot, up 10, 11 basis points on 30s to 229 almost. On a 10-year, 142 is your yield. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Five minutes away from the opening bell in New York City this Wednesday morning. Good morning. We're down 15 and off by 0.4% in the bond market. That's where the bite is coming from. Yields are higher by 7, 8, 9, 10 basis points through the curve. 10s out to 30s. That curve is steeper. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Citigroup upgrading Mattel to a buy with a 22.50 price target. The analyst expecting another round of fiscal stimulus to fuel robust toy demand through the year. That stock is up by 2.36%. Your second call from Wells Fargo, downgrading Square to equal weight, a 255 price target. The analyst highlighting a number of economic risks to its customer base. That stock there down a little more than 5% to 242.83 in the pre-market. And your third and final call from Jefferies, the team there downgrading Canopy Growth to underperform, a $23 price target. The analyst citing the stock's valuation and weak fundamentals compared to other US multi-state operators. Still, we are firmer by 0.7% in early trading. They're three of the calls behind us. Up next, the opening bell 1 year later. How the pandemic is reshaping markets. That conversation still ahead with Morgan Stanley's Dan Skelly. With equities lower, your bond market softer and yields much higher. This is Bloomberg.
The technology landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
At 25 seconds until the opening bell this morning. Good morning. A 6-day losing streak on the Nasdaq about to become 7. We're down hard. We're off by about 1 full percentage point on Nasdaq futures. The Russell just about positive. The S&P 500 down by 1/3. There's your opening bell. Switch up the board and get to the bond market. The Fed stays on message. The message is the same, but the world around us is changing, so there is a new message. Think about that. The reaction function becomes more powerful if the economy gets better and the Fed keeps saying the same thing. One thing that Chairman Powell reiterated, or at least introduced in the last 24 hours, is that higher yields are a statement of confidence. So there are your higher yields, Mr. Powell, up 8 basis points to 142.52 on 10s, up much more so on a 30-year yield. On a 30-year, we advanced 10 basis points to 228. In foreign exchange, the euro just a little bit weaker here at 121.32. Crude stays positive at 1% on WTI to 62.32. That's the cross-asset story this Wednesday at the market desk with your movers. Here's Abby.
John, let's start out with the big pocket of weakness. And of course, I'm talking about big tech. You were just highlighting that underperformance for the NASDAQ, now having its 7th down day in a row. Really incredible. The selling pressure we're seeing, of course, on these rising yields. Nobody wants to be caught holding the bag if valuation really comes into question as rates simply back up. So you have Apple, Microsoft, Amazon, Alphabet, all selling off. I have to stress again, Apple technically broken, which suggests you could see more selling. This is, let's call it 25% weighting to the S&P 500, 40% for the NASDAQ. That's why the selling is happening, not just today, but over the last few days. As for where the money is going, you've been talking about this sector rotation, the reflation, the reopening. Energy is one part of the complex in sympathy with oil. And actually, some of these stocks, they're coming well off their pre-market highs, reversing. So the sentiment, the negative sentiment about too far, too fast for rates backing up, that's really bleeding into one sector that had been working. Let's take a look at the banks, because earlier, the banks weren't really doing what you would expect the banks to do, which is have a rally, though now we do have a nice rally for the banks. Earlier, they were basically flat, even as yields were backing up. This is really where the money's going, not surprisingly, with yields on the rise. John.
Abby, you've been on top of the story year to date. The banks have been absolutely flying. Thank you. Top of the pile, the financials up 0.5%. Near the bottom of the pile, information technology down 0.6%. 12 months ago, it was Monday morning after Italy was locking down and yields were heading the other way. The outlook was getting worse and not better. 12 months later, yields are heading north and the outlook is looking better and better. Let's get to the story with Bloomberg's Sarah Ponzek. Hey, Sarah.
Hey, John, it really does feel like a lifetime ago, but a year ago today, the S&P 500 would go on to fall more than 3%. That week, the S&P 500 would fall more than 11%, and then we would go on to see the fastest fall into a bear market for the equity market on record. Fast forward after that, and we saw the fastest 230-day rally in 9 entire decades. The S&P 500 now more than 20% since the high that we reached last February in the previous bull market. Now, at the same time, though, you look at the hardest hit sectors that we saw in that time frame. They have staged a stunning comeback. Energy, financials, your best performing sectors this year, and we have seen them continue to come forwards. But let's focus on the bond market, because that is really where the action is this morning. The completely opposite picture of what we saw last February. This week, 1 year ago, we saw 10-year yields fall 32 basis points to 115. We are now above that now. You look at the 10-year this morning, you see it moving in on 150, above 140 now, higher than where we stood a year ago. We see the complete opposite of what we saw exactly a year ago today. You run through what we're seeing in the bond market across the curve. 10-year up 8.5 basis points this morning, 20-year up 10 basis points, 30-year now up 10.6 basis points just this morning, John.
Sarah, thank you. Sarah's spot on. 12 months ago, the story when the buying did actually start at the back end of March into April, it wasn't the financials. The financials got cut in half, some of these big banks in the United States. It was into the growth story. The growth story because growth was seemingly scarce. And now 12 months later, the outlook has totally flipped. Look at the banks year to date already. It's February 24th and the banks are up 20% and some on the KBW Banks Index. Unreal moves. Yields higher, curve steeper, outlook better, banks bid. Morgan Stanley's Dan Skelly saying it's a stock picker's market. He writes the following: we still favor reflation cyclicals. Growth companies are exposed to headwinds of higher rates, but you need to be highly selective and focused on growth stocks that can contribute to the digitalization of the economy. Dan joins us now for more over the phone. Dan, can we just start with the banks, please? The double tailwind, higher rates, better outlook. You're sticking with it?
Good morning, Jonathan. Thanks for having me. Yes, we are sticking with it. The banks are going to benefit as rates move higher here, and we're going to see a better economy in the second half, as you know, with credit improving, loans improving. And then thirdly, let's not forget capital return. The Fed has given the green light to buybacks and at some point probably dividends here increasing as well. So there are multiple tailwinds still ahead for the banks, Jonathan.
One stock's tailwind is another stock's headwind, and you know what I'm talking about, growth equities. You're talking about dual headwinds for growth, a deceleration of growth, so to speak, because of the pull forward as well. Dan, how do you identify who loses here?
Yeah, it's an excellent question, Jonathan. And whereas we think a lot of things in value land this year could be up 20 to 30%, with potentially limited dispersion and a lot of winners, we do see much more dispersion in growth land. And so we think there will be differentiation between winners and losers in the growth stocks. What do you want to look for, Jonathan, to answer your question? You want to really try to figure out which companies had a one-time pull forward in 20 and are going to have very difficult time trying to repeat that, and aren't going to be able to offset rising rates with rising earnings. And on the other hand, you're going to want to look for the winners in terms of the companies that are going to continue to benefit as their addressable markets, frankly, just continue to explode higher. So cloud, data centers, parts of e-commerce, parts of software. And again, Jonathan, the reality is with many stocks trading at high multiples in the growth spectrum, you just want to be much more selective in that world.
Do the losers rhyme with broom? I'm just trying to work it out, Dan. What are they?
When I look at some of the losers, I think it could be food delivery. I think it could be some of the things that were really pertinent to the 2020 environment in terms of the lockdowns. I think there are parts of streaming that are probably going to see their peak in 2020 as well. So you just want to be more selective.
More selective on the growth side, more dispersion. That's what you expect. So let's talk about the cyclical side.
Correct.
Dan, is it a little bit more straightforward on the cyclical side? Do you have to make a decision between energy and financials? Do you like one over the other? Do you need to make a decision?
I prefer financials of the two, frankly, because when you look at the space, not only are there near-term drivers when you think about the setup we talked about earlier, rising rates, capital returns, better credit, better loan growth. Longer term, I'm more convicted, Jonathan, that this sector can pivot towards the digital economy. When I think about all the investments that have gone into the sector in terms of upgrading technology, upgrading services, to think about the entire environment functioning so well from home, you know, that sector, I think we have more conviction longer term. On the other hand, energy is probably more of a short-term play on reflation. But when you think about the longer-term structural trends going on in that sector, there's so many obvious impediments, whether it's the rise of ESG, you know, the waning fossil fuels environment over time. So I think that is more of a short-term call.
Dan, I've got to get to a question that I imagine clients throw back at you a lot. The banks are already up 20% year to date. The energy sector on the S&P is already up almost 28% year to date. We still haven't closed out February. How much juice is left to squeeze here?
There's more room to go. And so if you look at our analyst, Betsy Graysick's work on the bank side, she's starting to talk more about her bull case playing out, particularly depending on what happens with credit and loans in the second half, right? So we are starting to see the potential for upside to our numbers. And keep in mind, Jonathan, as we've talked about many times over the years, you know, this was a group, both groups were out of favor for the last 5-10 years. And so valuations on more normalized long-term trends are still undemanding. And so we do continue to see upside there. And the very last thing we'll say is, as you know, we have a unique vantage given our data and given our relationships on the prime brokerage side as the biggest prime broker on the street. And we are not seeing tremendous overweighting in these spaces still. Yes, obviously, since the vaccine news last fall And since the Georgia runoffs went Democrat and the expectation for higher stimulus, yes, we've seen some increase in weightings, but they are by no means, vastly overweighted.
So, Dan, let's finish on this. The index story, the passive investing at the index level. We've gone through energy. Energy's 3%, not even, of the S&P 500. Financials is just a little more than 11%. Healthcare, IT, healthcare's 13. Information technology is 27. And the tech element to the other sectors on the benchmark too. The call from Mike Wilson, your colleague, is 3,900 on the S&P year end. Just how difficult is it to generate a big move higher from here at the index level, given the conversation you and I have just had in the last 8 minutes?
Jonathan, it's the exact right question. And frankly, the size of growth in technology in the index, as you're alluding to, is going to be the main impediment for the index this year. So this year is not as strong potential for the index level itself. Given rising rates and given the fact that investors, rightly so, want to rotate into some of these smaller sectors, some of these cyclical areas, the index is naturally going to run up against, a bit of a ceiling here at the 3,900, 4,000 level. We've talked about this, Jonathan, for the last several months and really all of last year. And it's a bit ironic when you think about it. Rates are frankly the last thing to move here. Stocks, when you look at value and some of the reopening stocks, have been really leading since the vaccine news in November. And so, look, with rates going up higher now, this is finally going to be the capitulation for growth. And it means that they're just better idiosyncratic ideas, not only in large cap value, but in small cap US and in EM.
Dan, good work. Let's continue the conversation, sir. Dan Skelly of Morgan Stanley there on the latest moves that we're seeing in this market. Yields are higher by 10 basis points almost on a 30-year to about 228, on 10s to 142, up 8 basis points. At a market desk with your movers, here's Abby.
John, let's start out with the pain trade because, of course, we have big tech selling off once again as those yields do rise. Now, we do have two stocks actually trading because of earnings in the tech sector. Square and Intuit are both sharply lower. Square missed revenue estimates. Intuit just trading lower with the tech sector. But the stocks that are really catching my eye, Apple and Microsoft. Apple really getting pummeled at one point over the last 7 days, down more than 10%, technically broken. This suggests that you could continue to see more selling in tech. And because the weighting of big tech is so strong to the S&P 500, as you were just mentioning, about 28%, it suggests there could be more weakness for the markets. As for where the money's going, as you were just talking about, it's all about the banks on the day. We do have the KBW Bank Index up 1.1%, one of the big money center banks, Bank of America, up sharply. The regional banking index is up even more, up 1.4%. KeyCorp, one of those stocks, rallying. And these banks on the year, John, if you can believe it, that KRE regional banking ETF up about 30% on the year in sympathy with the 10-year yield. If you can believe it, I just looked at this, up 50 basis points, the most since 2013 when, of course, there was that taper tantrum. Another tantrum happening right now, John.
A wonderful move higher. I have to say, yields up arguably for the right reasons. Yields up by 9 basis points on 30s, up 7 on 10s. The why, part of the why, well, coming up, another vaccine moving a step closer to receiving emergency use authorization. That conversation still ahead with Mandy Zhu of Credit Suisse. Equities inching a little bit lower, bond yields inching a whole lot higher. This is Bloomberg.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
This roadmap should be cautious, but also irreversible. The end really is in sight, Mr. Speaker. And a wretched year will give way to a spring and a summer that will be very different and incomparably better than the picture we see around us today.
Prime Minister Boris Johnson seeing an end to the pandemic and turning his attention to the recovery. This as vaccinations pick up across the globe, with the FDA deeming J&J's single-shot COVID vaccine both safe and effective. For more, here's Katie Lyons.
Safe and effective, that is the headline, John. The FDA in its report saying that the vaccine has an efficacy rate of 72%. That confirms J&J's own findings. There were also no COVID-19 related deaths in the trial study. Now, a panel of advisors to the FDA will vote on whether or not to recommend the shot for emergency use authorization on Friday. If that is granted, it could substantially boost the vaccine rollout here in the U.S., especially given it's a one-shot vaccine and it can be kept refrigerated for 3 months rather than frozen. As it stands right now, the daily vaccination rate in the U.S. over the last week has been about 1.3 million doses, slowed down, of course, by the deep freeze that we saw in many parts of the U.S. About 65 million doses have been given so far. Now, J&J, if it comes into the equation, has said it will be initially able to provide 4 million doses and that by the end of March, it can produce 20 million. That adds to a coming surge in vaccine availability. According to a Bloomberg analysis, if you couple that J&J number with the promised vaccines from Moderna and Pfizer, you could inoculate 130 million Americans fully by the end of March. So this is where the optimism comes from, John, the optimism that a vaccine is going to lead to an economic recovery. And nowhere is that more evident than in the bond market. Over the course of the year thus far, less than 2 months, we have seen the 10-year yield up 50 basis points, selling in treasuries with bets on better growth, bets on reflation. Of course, fiscal stimulus is part of this equation as well. Today alone, we're looking at a move of 8 basis points on the 10-year treasury yield up to 1.42%. And J&J has an important part to play in that price action today.
Very much so. Kelly, great work. Thank you. Kelly Lyons there at the market desk on the bond market move, up 10 basis points on 30s, as she says. Guy Johnson, no doubt, will pick up the theme here for the gilt market in the UK. 10's up 8 basis points. Your 50-year over there up 12 basis points. The real concern about rate sensitivity and the rate-sensitive parts of this market in the bond market, duration has been the major concern over the last couple of weeks, and you see it playing out today. The why so many people have come on programs like this and talked about shortening up duration. For the equity market, it means a couple of things. It means growth equities get hit. It means the cyclicals, the banks do quite nicely. We've seen that through the year as well. Mandy Zhu at Credit Suisse, focusing on the recovery playbook. She says the following: the rotation trade remains the key focus. Elevated sector and stock dispersion helping to keep a lid on S&P volatility. Mandy joining us now for more. Mandy, let's just start with the bond market. Yields are moving higher. The curve is steeper. How's that shaping your world?
Thanks, Jonathan. It's great to be here. So I would say what equity investors are focused on is not just the move higher in rates, but also the surge in rate volatility that we've seen over the past 2 weeks. That's been a big driver, I think, of anxiety on the part of a lot of equity investors, because it brings to mind previous episodes, for example, 2013 or October of 2018, where we saw a sharp move higher in rates and the tandem rise in rate vol and equity vol. So far, at least, equity vol has been rather tame. So I've gotten a lot of questions as to why we haven't really seen a big reaction in terms of the VIX. And to me, it really comes down to why rate vol and why interest rates are going up in the first place, right? This, higher rates is only a problem for equities when the Fed Fed thinks it is a problem for equities. And the Powell Fed has made it clear that they are not concerned at all with a temporary overshoot inflation. In fact, they welcome it. And as a result, higher rates due to stronger cyclical growth expectations, that's not necessarily bad for equities, right? And that's why at the broad index level, we're not seeing much of a negative reaction. And as you mentioned, we're seeing, a big rotation at the sector level, but at the broad index level, vol moves have been very muted in equities as a result.
Mandy, the conditions that you described, do you expect them to persist?
We do. So we think this rotation is actually still in the beginning stages. So, if you look at investor positioning, yes, people have been cutting back on their growth exposure, have been cutting back on tech, but broadly speaking, the institutional investor base is still overweight tech and underweight, if you look at, for example, our prime brokerage data, still underweight a lot of the cyclical sectors, for example, financial. So we do think, this rotation is still in the early stages. And then in terms of the macro drivers, you mentioned on the show, right? Like accelerated vaccine rollout, bigger than expected stimulus, et cetera. I think there are a lot of macro factors in addition to positioning factors that can drive further rotation. And that's why, in the derivatives market, the predominant theme that we've seen over the past few weeks has been upside chasing in a lot of these cyclical sectors. We do think that has further room to run.
So, Mandy, you are the second guest in the last 10 minutes or so that's talked about the underallocation to this theme. It was Dan Skelly at Morgan Stanley, a peer of yours just moments ago, and Mandy Zhu at Credit Suisse, repeating the same thing, this underallocation, and some people really struggle with that, given the outperformance we've seen at the back end of October through to 21 and into the end of February. So that's the analysis, Mandy. Talk to me about the best way to express the trade in your mind at the moment.
Sure. So we are recommending looking at sector specific, or if you can, even going at the single stock level. Again, I talked about the sector dispersion being kind of the main theme and the main kind of implication of this reflation trade. So specifically, we like looking at further upside in sectors that are most positively correlated to higher inflation. And that's banks, that's energy, that's metals and mining. And then specific option structures that we like, given the fact that volatility in these sectors are still relatively elevated, and given that most of the demand that we've seen has been to the upside, structures we like are, for example, buying upside call spreads and selling a downside put to funded. These types of structures take advantage of the high vol and the rich upside call skew. That's probably our favorite way to implement that in the derivatives market. But thematically, looking for further upside in these sectors, in these cyclical sectors, is what we like going forward.
Mandy, this is a US call, I assume, and typically you indulge us and talk to me about the relative trade into Europe. What is it now?
It's interesting because European markets are obviously even more cyclical than U.S. if you look at the sector breakdown, right? So they don't have as heavy of exposure to mega cap tech, for example. But what's also different this time around is that a lot of the fiscal stimulus is coming from the U.S. Yes, in Europe you have the EU Recovery Fund, but it's nowhere near the same magnitude. So from a fiscal stimulus perspective, and then especially from a vaccine rollout, like continental Europe, for example, has been very, very slow in terms of a little bit mixed. Normally I would say, European equities should outperform U.S. equities in this environment, but given the fact that they have less fiscal stimulus and slow vaccine rollout, it's a little bit unclear right now to me. I would make the call that, Europe is going to outperform the U.S. going forward.
Mandy, you know how much I love catching up with you. Thank you for this morning. Mandy Zhu there at Credit Suisse on this market. Mandy mentioning the sector price action. Let's get there. Here's Abby.
John, it's pretty interesting. If we go into the Bloomberg terminal and take a look at the sector composition using the IMAP, it's not as risk-off as it looks. Now, we do have more sectors down than up, but up top, it's all about those two reflationary sectors in particular. Actually, the top four: energy, financials, industrials, materials, all the reflationary reopening trade up there. The thing about it, though, is that's probably about 20% of the S&P 500's weighting. On bottom, the 51% that goes to tech and mega caps, that's what's weighing. And here is the rotation over the last 2 weeks. You can see the money very clearly going into energy and that regional banking ETF, both up about 10% in 2 weeks on the reopening, reflationary rates backing up and coming right out of tech and consumer discretionary, which of course is largely Amazon. Very clear picture there, John.
Abby, thank you. S&P Financials, record high. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. This is Bloomberg.
let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Equities lower on the S&P by 0.25%, on the Nasdaq much lower. Let's get you the trading diary.